Oh, why is I started recording? Is
Yes,
it
sir. No.
Started
verified?
now. No, it's verifying. It's automatically started, so we'll keep ourselves muted.
Yes, Chairman, sir.
Hello, live போகுதா?
Yes, sir, we are live, sir. The automated started. No system started. We'll start in 10 minutes. We'll keep display boards. Till then, we'll keep our system. Sir, am I audible?
I'm audible.
Yes, you're audible.
Good evening.
And we are already live, sir.
Is it okay now?
Yeah, it's little bit better, sir. We are live already with the audience. We are ready to start the session, sir, and we'll just check the screen sharing part alone once. I'll give you the right, sir. Can you just check it out once, please? Important, sir.
Sure.
Yes, please. Now it's better, sir. Can you check the screen sharing part, sir? Visible, sir. Now we can stop the screen sharing part and we'll start in another 5 minutes. We have another 5 more minutes to start the session. The third button to stop the screen sharing part, sir. Thank you, sir.
Chairman, good evening.
Good evening, sir. Good evening, sir.
We have 9 more minutes.
3 more minutes, sir. That means. So we can start some almost 5.
Very respected speaker of this evening, CAV Ramnath from my own town, Coimbatore, Secretary of SIRC, CA Panaraj sir from Bellary, participants of this evening program, very good evening to all of you. It is always a pleasure to be amongst our elite professional fraternity, and added to being together, my happiness is much more when assembled to discuss on matters of professional importance and interest. The tax audit is one of the important assignment for most of our professional fraternity. Our tax audit reports will reflect our professional and ICAI image with the government and other stakeholders. We SIRC keep this in our mind. We have decided a program on the topic of tax audit report with particular reference to forms 3CA, 3CB, and 3CD, giving a specific focus on the common errors committed while preparing the tax audit report, thereby resulting in non-compliance of certain provisions of Income Tax Act 1961. The gracious presence of our speaker, CAV Ramnath sir, who has a phenomenal experience, expertise, and exposure in tax audit. In fact, he is one of the mentor and well-wisher, and for me, it's a great motivator to discharge my duty as a chairman of SIRC. His presentation on the common errors that is found in a tax audit report will be an eye-opener for the participants to understand the prone areas where there is a possibility of occurrence of such errors. I'm sure the eruditors and speaker of eminence would bring forth a new insight and the possible solutions to overcome from committing such errors, thereby enriching and enlightening the participants of this evening. On behalf of SIRC, I welcome the speaker CAV Ramnath sir for his important program, and thank him for sparing his valuable time to share his knowledge and wisdom. I'm happy to welcome each one of the participants for this excellent program. With these opening remarks, once again, I welcome you all for this important program. Before into the technical topic, I request Secretary of SIRC, Panaraj sir, to introduce our man from Coimbatore, CA Ramnath sir, to the viewers.
Thank you very much, Chairman sir. It's always pleasure to watch the presentation by Ramnath sir. I most of the time never miss, even though I am busy, wherever I am, I wish to listen to him for his simple, straight, and very, very knowledgeable presentation, which will be very practical. So that is the special quality Ramnath sir has. So he has been a teacher like to most of the members. Sir, very warm welcome once again to you. He is a BCom graduate and fellow member of the Institute of Chartered Accountants India. He underwent his graduation in Government Arts College, Coimbatore, Tamil Nadu in 1993. He pursued Chartered Accountancy during 93-96 under Sri K. Palaniswamy, Chartered Accountants, Coimbatore. He cleared his CA intermediate examinations, obtaining 33rd rank on All India basis, and CA final by obtaining 43rd rank on All India basis. He was a gold medalist at Coimbatore branch level in CA final. Presently, he is practicing for the 24 years in various fields, audits, corporate and non-corporate entities. He is has also handled the appeals under the income tax up to income tax tribunals. He also handles corporate and non-corporate restructuring cases. He was a faculty for the CA final direct taxes at the Coimbatore branch for 17 years. So he presented papers in direct taxes in seminars and conferences organized by various branches of the SIRC. He also addressed the students at various colleges on topics to commerce and taxation, etc. He is also a member in the academic and governing council of various education institutions at Coimbatore. He was a co-opted member of the Direct Tax Committee of ICAI for the year 2020 and presently co-opted member of the Direct Taxes and International Taxes Committee of SIRC of ICAI. With this brief introduction, I hand over the proceedings to Ramnath sir. Over to you, sir.
Distinguished Chairman, Secretary, and other office bearers of the SIRC of ICAI, senior members of the profession who continue to guide us, fellow members. It's a pleasure to stand before all of you and share some of my thoughts on the topic assigned. Now, the topic is common errors noticed in the audit reports filed by our fraternity. Before we get into the topic proper, we'll get certain fundamentals into point. All of us know very well form number 3CA, 3CB are audit reports, meaning we are expressing the opinion. Therefore, materiality matters. Form number 3CD is a statement of particulars where factual accuracy is important because it is certifying. In this particular form, we are certifying the correctness of the information furnished. Now, whenever we are going to give our information or our opinion on the form number 3CA or 3CB together with our correctness of the information furnished in form number 3CD, we have to restrict ourselves to the books of account audited information emanated therefrom. This clarity is necessary because in certain classes when we are filling up the information in 3CD, we will have to first make ourselves very clear that we are furnishing the information based on the books of account audited. For example, we may be preparing or helping the SSC in preparing the return of income. The SSC being an individual, we may come to know that he has some chapter 6A benefits eligible for him, like life insurance premium paid, etc. In those cases, when the books of account which we have audited doesn't come up with all this information, but we may know the information about the SSC, we'll have to confine ourselves to furnish information based on the books of account provided. The column relating to deduction of eligible deduction under chapter 6A, whatever information we are furnishing should be confined only to the information emanating from the books of account, and the additional information assessee may give while furnishing return of income. We may be aware of it, but while coming to the report, we'll have to confine ourselves only to the information coming from the books of account. Then, as our institute repeatedly gives guidance to us, this audit requires good amount of documentation, whereby at a future point in time when our members are expected to justify why a particular view is given or why a particular position is taken, our documentation only should help us to make ourselves clearly establish that we have done our duty properly. And whenever a case law is sought to be relied upon for furnishing an information in a tax audit report together with the information given in form number 3CD, it is better to rely on it while furnishing that, while relying on a case law, better to furnish that case law reference etc. in form number 3CA or 3CB para 3 or 5 recurses respectively. the topic is picked up from the literature came up from the Taxation Audit Quality Review Board of ICAI constituted in 2018. That has led to the topic becoming popular, and many amount of seminars conducted by TAQRB, DTC of ICAI, also available in the web portal of the ICAI, which also talks more about this. Personally, I have not got the opportunity of working in TAQRB to know all these errors. By listening to the web portals, the seminars placed in the web portal and the publications of the TAQRB, I have compiled all the errors, shortcomings noticed by the TAQRB. I do not have a first-hand information on it, but also from some of the discussions I had from the family practicing members, I could gather certain important aspects which I thought worth discussing in this evening. Now, TAQRB, constituted in 2018, made some research on the audit reports, tax audit reports furnished by our members in the portal, and collected the physical copies also, and then studied what was the expectation from stakeholders and how our members have performed. Whatever we are going to discuss, maybe 1 in 100 or 1 in 1000 cases. Honestly, many of our members are judiciously spending our time, and we are giving good best what we could otherwise do in a given circumstance of the case, and trying to discharge our responsibilities most honestly. Whatever noted down are only aberrations, or only a small percentage, and as mentioned in the preamble of the TAQRB literature, the idea is only to see that the quality gets enhanced, and whereby the stakeholders believing that our fraternity performing our work well would also get satisfied with what we are performing. So the idea is only to see that in 1 in 100 cases wherever it's happening, that also should be addressed, whereby the image of the profession as a whole would go up. That's the idea. So in preamble to say, whatever we are going to discuss in another and never plus would be only a case of exception that need not be generalized, or one need not think that many of our family fraternity is performing like this, but even 1 in 1000 may give an image that things are not compatible. Therefore, we will have to see that these small things also get addressed by our fraternity. And in the May month journal of 2021, the TAQRB article had come, page number 36 to 41 of our ICAI May month journal, wherein these errors are codified and presented. It is in fact essential for us to understand that the TAQRB's role is not only restricted to evaluate the audit report furnished by the chartered accountant under section 44AB. It also has got the mandate to consider all other audit reports, not only under income tax law, also under other legislature. But whatever so far done is only the report furnished under section 44AB. And the TAQRB came out with a checklist for conducting tax audit. That checklist is available in a PDF form in our institute website, and our members can download and use it, so that when we comply with all the clauses of the checklist appropriately, majority of the issues are getting addressed, and whereby we will not get any feel that we have omitted something. In a very classic way, very meticulously checklist was prepared and made it available freely for our members. So before conducting the audit, tax audit, if it is possible, we can pull out that checklist and start using it, so that the juniors working in the office also will get some discipline as to how one has to document, how one has to collect papers, present it, preserve it, etc. So that later point in time, when a question comes about verifying how we have done the audit, this checklist will go a long way in bringing discipline and uniformity in discharging our attest function. Though the meetings conducted by ICAI, TAQRB of ICAI, as well as Directors Committee of ICAI, as well as several literatures in the recent 1 year came up dealing with non-compliances errors in form number 3CA, 3CB, read with 3CD, one can, on a holistic approach, divide them into two broad segments. One is compliances were not followed under income tax law. The other segment could be compliances when with reference to the ICAI pronouncements. In income tax law, whatever non-compliances presented could be divided into a few more categories, subcategories, choosing the correct form, filling up the clauses of the form concerned, inconsistency with other information made available, and not having adequate disclosure in the form concerned. These could be broad categories when we are discussing the errors found in the audit reports furnished. With reference to non-compliances in the ICAI pronouncements, non-compliance of accounting standard, auditing standard, and other pronouncements may be noticed, which under income tax law there may not be consequences, but as member of our institute, when the report contains or the financial statement contains something which is not in accordance with accounting standard and our auditing standards are not followed, when we present the form, the penal consequences will follow in the ICAI proceedings. So therefore, non-compliances under income tax law may invite trouble in the income tax proceeding as well, and by not discharging the responsibility properly, that may in turn result in ICAI proceeding as well. But pure non-compliance of the ICAI proceedings may result only in penal consequences under the ICAI proceeding, which is unpleasant, and therefore one should not end up in doing it. Therefore, as far as possible, we only should feel that we are complying with this so that we are not landing into difficulties of that nature. So now part A will take up the non-compliances or errors found in following the income tax provisions. That will take up for our discussion. Now, first segment is choosing the form. Much was deliberated in identifying which form we have to choose, form 3CA or 3CB. All of us know 3CA and 3CB are the reports of audit, and 3CD is only particular to be annexed, a form of the particulars to be annexed along with 3C or 3C. Now, interestingly, 44AB says every person carrying on business, profession, and presumptive cases falling under 44AE, and presumptive provision falling under 44ADA, presumptive provision falling under 44AD. These 5 subclasses are available, A, B, C, D, E, shall get his accounts audited for such previous year by an accountant before the specified date and furnish by that date the report of an audit in the prescribed form and verified by such accountant and searching for such other particulars as may be prescribed. Now, the rule prescribed for this purpose is Rule 6G. What does Rule 6G say? Very importantly, Rule 6G says, in case of person who carries on a business or profession and is required by or under any other law to get his accounts audited, the form should be 3CA. So if legally there is a requirement to get the accounts audited under any other law, not under income tax law, under any other law, then the form should be 3CA. But in case of a person carrying on business or profession but not falling under clause A mentioned above, then it should be form number 3CB. So that means there must be a necessity to have an audit under any law, in which case we'll have to choose form number 3CA. But in case where a person is not required or obligated to have an audit under any other law, then there would not be a requirement under to issue form number 3CA. We will have to have form number 3CB. Now we'll examine this further. This is supported by the language of form number 3CA as well. If you see para 1 of 3CA, it says we report that the statutory audit of that assessee, name and address with permanent account number or Aadhaar number, was conducted by me or Messrs. So and so in pursuance of the provisions of such and such act. And we annex here to a copy of our report or their report dated so and so along with the copy of financials, etc. That means law, by giving this language in the form, says that the audit is conducted in some other law in pursuance of the provisions of such and such act, number 1. Second, the audit should result in issuing an audit report for the financials. It should be, the further language says we annex here to a copy of the report, audit report dated so and so, along with copy of financials, etc. So there must be an audit under some other law, and it should result in issuing audit report with financials, etc. Now that is another aspect is the audit need not be conducted by the same auditor, because it uses the language by me or so and so, and if I have already conducted the statutory audit under some other law, I should say I am attaching the copy of my audit report. My audit report. If somebody else has conducted, I'm doing only the tax audit, then I should say audit is conducted by Mr. So and so or Mrs. So and so firm, and I annex here to a copy of their audit report dated so and so. That means statutory audit conducted under some other law by somebody else, some other chartered accountant, and I am only giving the report of theirs. Now, interestingly, what is that we are annexing? Audited P&L account for the period beginning from so and so to ending so and so, audited balance sheet as at particular date, and documents declared by the said act to be part of or annexed to. Very important language. Our TAQRB mentioned about it, and therefore we need to have an importance on this particular class C. Documents declared by the said act to be part of or annexed to the P&L account and balance sheet. So it is not mere P&L account and balance sheet. It is also all other documents declared by the said act to be part of or annexed to the P&L and balance sheet. Now, companies requiring audit under the Companies Act. Whether we will have to issue form number 3CA or 3CB. Generally, the presumption or the understanding would be for a company, audit under Companies Act comes, and therefore form number 3CA is appropriate. Now, let us take, for example, a company newly started somewhere in the month of February. Under 1956 Companies Act, the company has a choice of taking for the first year alone more than 12 months. Now, it's a company which has floated in the month of February. In 1956 Companies Act, instead of closing from February to March as one financial year, the company may opt to take the first financial year commencing from 1st February to next March. That means for 14 months it can have one financial year under the Companies Act. But Companies Act 2013 is slightly worded differently, whereby if it is commenced from 1st of January, first year should be definitely for the next year only. That means from 1st January, not immediately closing 31st March, it should be the next 31st March. That means any company commencing on or after 1st of January in a financial year, that cannot close within that 2-3 months time. It has to wait for another 12 months and make a mandatory 15 or 14 months time, depending on when they commence when they get incorporated. Now let us take this case. February 1st, company got incorporated. Up to 31st March, turnover crossed 1 crore of rupees. Business is doing good. Now, this company, under the mandate of Companies Act, not required to have its accounts closed and audited for the period commencing from 1st February to 31st March. It can wait for another one financial year. Now, for this year, necessarily, for this year, for the 2 months if the turnover has crossed 1 crore rupees in a business, necessarily the company has to get the accounts audited under income tax law by virtue of section 44 AB clause A. So therefore, as it is a company, as merely because it's a company, it is not always necessary that it will always have form number 3C. So the February and March 2 months, the turnover is 1.5 crore. It has to get the accounts audited under 44 AB clause A. Now that means the regular Companies Act audit would not be there, and income tax audit would be there. The board or a managing director will sign the accounts, give it to the auditor. Auditor will follow all the rules of how a non-corporate entity would otherwise get audited. All the procedures would be followed for conducting audit, and an audit report will be released in the income tax law under 44 AB clause A. So in that case, form number 3CB shall be issued for that period commencing from 1st February to 31st March. Now let us go to the next year. In the next year, Companies Act required the company to have the accounts from 1st February of 1 year to the subsequent year's 31st March. So that means 14 months there is only one audit. That audit report, that accounts may not be workable for issuing tax audit report or conducting tax audit and furnishing to the income tax department. So The next year, 1st April to 31st March. The 12 months, again, there will be an audit under income tax law because Companies Act period is 14 months. Audit conducted under company law is only for 14 months. Now we want only for 12 months from 1st April to 31st March. That means again in the subsequent year, for 12 months, a board accepted account should be presented, signed by managing director on behalf of the board, and the audit has to be conducted under income tax law, and the appropriate form for that purpose will be form number 3CB. Merely because it's a company, one should not get into the field that only 3CA would apply. It will be 3CB also when the newly started companies adopt a form which is the period which is not exactly matching with the income tax law or the mandatory provisions of, because of the mandatory provisions of the Companies Act 2013. Now, those olden days where companies are entitled to follow different financial year, but 2030 that's not possible. If they were following, they have to synchronize. In those cases also, when it is not ending up with 31st March, form number 3CB would be applicable. For an existing company which is following 31st March, April 1st to next year 31st March as the financial year, which is continuing for several years, then in that case, companies would require the accounts to be audited. Since it is audited under some other law, then the appropriate form would be form number 3CA. Now let us come to LLP. LLP requiring audit. Under LLP Act, when the contribution exceeds 25 lakhs and turnover or turnover exceeds 40 lakh rupees, necessarily audit is required to be made under LLP Act. The irony here is the agreement of LLP may say even for a lesser turnover or a lesser capital contribution, the parties may opt for getting it audited. But that is only a voluntary projection, and law does not require them to get the accounts audited. In such scenario, what happens? Now, let us say audit is warranted under LLP Act because of the turnover criteria or because of the contribution criteria. Now, audit under LLP Act, audit under any other law. Therefore, under Income Tax Act, no further audit is required. Form number 3CA would apply. If an LLP by an agreement demands for getting the accounts audited, even for a lesser turnover or lesser capital contribution, that is not an audit under any other law. It is not required to get the accounts audited under any other law, and therefore, for that case, form number 3CA will not come, and that particular type of LLP is not required to get the accounts audited under income tax law also under 44AB. Therefore, form number 3CB also would not come. For the management sake, they may have the accounts audited through a chartered accountant. But that in the eyes of law is not considered for the tax purposes an audit required under the Income Tax Act. Therefore, for that case, definitely there will not be a form number 3CA, there will not be a form number 3CB. A general purpose audit could be conducted and produced to the management. For in the eyes of law, it will be considered as if an audit is not warranted. The consequence would be, for an audit case, we have extended due date. For a case where the audit is not warranted, the management may opt to get the accounts audited, but law does not require them to get the accounts audited. Therefore, for them, the due date contemplated under section 139 subsection 1 would be for a non-audit case only. Merely because management opts to get the accounts audited, we will not be able to get the extended due date. So in consequence, loss returns have to be filed before the stipulated time, and there are some benefits under chapter 6, etc. They have to take care of it, and all that factors for filing the return within the due date, 234A, 271F, all that we will have to see that they don't end up in trouble. Merely because they ask for an audit, they will not get the time extended for furnishing return, etc., which fact one has to keep in mind. Similarly, cooperative societies, when audit is contemplated under that law, due date for them gets extended, and the form to be chosen is only form number 3CA. If the dates synchronize with April 1st to subsequent year 31st March. Audit under GST Act, of course, whether at all this is required to be discussed in the light of form number 9C getting replaced with that last subsection 5 is not being available, a self-declaration coming from the assessee side. It is going to be technical, but still, in those years when the GST audit was going on, one school of thought comes up with the say that the audit under GST Act is not for expressing any opinion on the financial statement. It is only talking about the returns, correctness of the returns furnished. Therefore, one would not be able to equate it with an audit under any other law to express an opinion on financial statement. Therefore, that should not be considered as an audit under any other law. For that case, where only GST audit is required, but any other law is not, then in that case, form should be only 3CB is what one school of thought. Another school of thought, audit under GST Act is mandatory. For them, no other audit under any other law comes in. In that case, also we can say it is audit under any other law. We will choose form number 3CA in that case. But in my opinion, this in the long run is going to be academic, because that audit itself is not going to take up. It is going to be a voluntary compliance by the SSC. So the next important point, that class C of that form, which we have discussed in form 3Z, documents Annex 2 declared to be part of the financials we are attaching. TAQRB noted that in some of the cases, the first page of the profit and loss account, first page of the balance sheets were appended as PDF, but the entire set of schedules, notes forming part of the profit and loss account and balance sheet not uploaded. That is not appropriate, because we say the statutory audit is conducted either by us or by somebody else, and we annex here to the audit report dated so and so, along with financial, that is P&L account, balance sheet, all documents declared to be part of the financial statement. Therefore, the entire notes and schedules to the P&L account and balance sheet are to be uploaded. Merely uploading the first page of P&L and first page of balance sheet, the face part of it alone, is not an appropriate compliance of law. This is what the TAQRB noted in some of the cases, whereby we will have to be a little more careful. In some of the cases where for want of time or for some reason it is omitted, it is appropriate to incorporate this and ensure that the entire documents were uploaded along with, while for uploading the return in electronic form. Now that is with reference to choosing the form. Now we'll come to filling up of the classes. When classes, the information is given, what is that we will have to consider? Primarily, we will have to make one thing clear, that the information given in form number 3CD, who has to do? In all SME cases, by and large, we will help the SSC in compiling it of the record to say. But law expects the SSC to furnish that information. Our job is only to verify that information and ensure that it is in accordance with the expected form. So it is the primary responsibility of the SSC to furnish the information in form number 3CD. Our responsibility is only to verify the correctness of the same. So even in some of the smaller cases, we help them in appraising the law, in culling out information, etc. However, it's advisable to get one copy of form number 3CD duly signed by the management, furnished to the auditor for the purpose of verifying the correctness of the same. So in our audit documentation, we'll have to ensure that one copy of form number 3CD signed by the management, not by us, before we start audit, signed by management and addressed to us, requesting to verify the correctness of the same. If we keep it, that would be all the more helpful for us to defend that this is the information SSC has given to us, asking us to verify, subject to applying all the test checks, all the audit procedures expected of from us by the institute as per its guidance note and other pronouncements. If we have done all these things, it will help us to say we have done our audit in accordance with the auditing pronouncements. Even thereafter, if something is left over, then we don't need to be worried about. But primary aspects not properly taken care of, we will not be able to escape. But at least we will say information got culled out only by the SSC. SSC has given, we have applied all the audit procedure to verify the correctness of the same. If you have taken care of that, then at least to that extent it will help. So fundamentally, the responsibility of furnishing the correct information in form number 3CD is that of the SSC. Our responsibility is only to verify the correctness of the SIM. Therefore, adequate documentation is necessary in order to ensure that we have followed these institutional pronouncements properly. Now we'll get into classes. As I already mentioned in the beginning, we will divide them into 3 segments. When filling up the classes by SSC and when we are verifying the correctness of the SIM, what are the precautions one has to take? What is the TAQRB has noticed? That is one thing we will see. Second one is cross-verifying information from one end to another end. What are the observations TAQRB came up with? And third one is proper disclosure. That way, we will divide them into these 3 segments and we'll see. First, class number 6. Talking about previous year. Earlier, it was only previous year ended on. But very interestingly, 4 years or so back, the form got amended to say previous year from so and so date to so and so date. That means the legislature in its wisdom thought it fit to introduce from and to. That means for a newly started business or a business which got cessation in the middle of the year, the auditor is expected to verify whether the dates given are appropriate. For all the cases, it is not necessary that all the cases we need to have only commencing from 1st April ending on 31st March. A business which has commenced in the middle of the year ended on 31st March, that from date will be different from April 1st. But if it continuing, 31st March would be the closing date. Business which is ongoing but not there on the 31st March, but before that itself got wound up. In that case, the due date will not be 31st March, it could be an earlier date. That needs to be verified and properly with adequate documentation and seen that it has been properly filled up. Now, class 8, this is where TAQRB has also opined as to how one has to handle this. Now, if you see section 44AB carefully, it is here we will have to spend a little more time. Section 44AB, class A says audit is necessary under Income Tax Act when the turnover, gross receipt, sales in business exceed 1 crore rupees. That is what class A of 44AB talks about. And of course, we have a proviso below that clause here to say, as long as the SSC has cash transaction on its receipt side, as well as on the payment side, less than 5% of its gross receipts and gross payments as the case may be, then instead of 1 crore, this ceiling limit would get extended to 10 crore for the financial year ending 31st March 21. So the limit is increased 10 times so long as the SC is willing to go under an electronic mode. So if all receipt side part, if he has got 95% above on electronic mode, as well as on the payment side also, he has indulged the transactions only in electronic mode for 95% or above of his payments, then for him, for audit purpose, the requirement of turnover is only, ceiling limit of turnover is only 10 crore, not 1 crore. Now, this is also given in the schema, proviso to class A. Proviso to class A says one has to get out of the audit. Proviso to class A does not say you should conduct an audit or you should get the audit done. Class A requires audit to be done. Proviso to class A 44AB says audit need not be done or rather should not be done. It is not an option for the SSC. It should not be done. So in that case where the turnover is less than 10 crore, more than 95% on receipt side and payment side, the SSC has indulged only in electronic form, non-cash form, then he should not conduct an audit. In that case, eventually choosing proviso below class A of section 44AB would not arise at all, but still schema provides for it. Now, the proviso below class A cases, audit is not required if they satisfy these conditions. As an auditor, we will have to ensure that whether the SSC has followed this condition whereby audit is not warranted. In case the SSC has followed this condition, nevertheless, SSC wants the audit to be conducted for some reason, for his discipline, financial discipline, etc. In which case, audit will not be conducted under income tax law. It will be conducted only under general principles. That means a general purpose financial statement audit we will conduct. We will issue a report normally by going by SA 7 entry. It is not an audit conducted under the Income Tax Act. In which case, that audit, income tax law, we will not come up with any audit report in form number 3CA or 3CB. Thereby, effectively, at the cost of repetition. For that assessee, the due date will not be the similar to what an audit assessee is entitled to. An extended time will not be available for him. Is something which one has to take care of. Now, Class B talks about audit under Income Tax Act, where the gross receipts in profession exceeds 50 lakh rupees. Now, third scenario, audit under Income Tax Act, then the presumptive income under 44 AE or non-resident cases, 44 BB and BBB not offered. And Class D talks about audit under Income Tax Act when the presumptive income not offered under 44 ADA. That means professionals coming under 44 AA subsection 1. Notified professionals or specified professional, totally 11 professionals specified, and they claim their gross receipt is less than 50 lakh and also their actual income is less than 50%, then audit is warranted, subject to income exceeding the basic limit. And Class E talks about audit under Income Tax Act when section 44 AD subsection 4 gets subtracted and coupled with subsection 5 and this Clause E. Now, if you see carefully, all these Class A audit under income tax law subject to doing certain conditions satisfied. Class B audit under income tax law for a professional category. Very important to note, for a business case, when somebody follows electronic mode of conducting activities, the turnover limit increased from 1 crore to 10 crore. Correspondingly, there is no proviso below Class B, where a professional having more income than 50 lakh rupees for his professional gross receipts, even if he has done 100% through electronic mode, he does not have any extended threshold for not getting the accounts audited. The professional firms or professional individual, once it crosses 50 lakh rupees gross receipt, he has to get the accounts audited. That extended turnover criteria available for people following methodology of through electronic methodology, that extended quantum is not available for Class B. Now, third proviso to section 44 AB says, if the assessee is liable to get the accounts audited under any other law, it will be sufficient compliance not to get the accounts audited under 44 AB. It will be sufficient compliance if that audit report is annexed and the statement of particulars alone is given by this auditor. That means if the assessee is required to get the accounts audited under any other law, it will be compliance of this section provided that audit report is taken on record, provided the previous year should be from 1st April to subsequent years 31st March, not something else. One. In which scenario, there is no need to get the accounts audited under income tax law again. The form number 3CD, statement of particulars alone is given by the tax audit, it will be sufficient compliance, but the audit report of that audit under any other law conducted by the auditor and financial statement together with note schedules, etc. should be furnished. That is what the law expects. Now, let us say, for example, a company. Now, a company having 1st of April to 31st March of the subsequent year as its financial year conducted the audit in accordance with the Companies Act. Now, Class 8 of the tax audit report, form number 3CD, says under which class you have conducted the audit and you are furnishing this report. Now, effectively, the company's turnover exceeded 1 crore rupees. Business turnover exceeded 1 crore rupees. Now, TAQRB observed that many of the cases when a corporate had gross turnover, gross receipt sales exceeding 1 crore rupees, people have opted for section 44AB Class A. But effectively, when a company has financial year ending 31st March, got the accounts audited under Companies Act, thereafter we are only furnishing, we are relying on that audit report, furnishing information, verifying the information given in form number 3CD, then the appropriate clause which we have to choose in Class 8 would be third proviso to form section 44AB. That is what is required to be chosen. So many companies, when form number 3CA is given, but in Class 8 of 44AB, in many companies' cases, it was chosen as Class A to section 44AB. The appropriate reference should be third proviso to section 44AB. Whenever we take up form 3CA, it should be third proviso to section 44AB. Whenever an audit is conducted under the Income Tax Act, it will be form number 3CB. Once form number 3CB comes, we will have to examine whether it will fall under class A, class B, class C, or class D, or class E. All the 5 things we have to see. But when third proviso gets attracted, it is form 3CA, and we have to say in class 8, it is only third proviso to section 44AB. This is what the TAQRB has observed. Many of the corporates where form 3CA was issued by the auditor in class 8 of 3CD, it was mentioned as class A instead of third proviso to section 44AB. Now we'll come to section class 11 of the form number 3CD. It talks about books of account. We had 3 subdivisions there: class A, class B, subclass A, B, C, or class 11. Subclass A says books of account prescribed. Whether books have been prescribed, if so, the list of the books prescribed. Class B talks about books of account maintained, and subclass C talks about books of account examined by the auditor. Now, very interestingly, section 44AA subsection 1 prescribes for 11 professionals books of account in rule 6F. There are some specified professionals in section 44AA subsection 1 also notified by the CBDT. Put together 11 professionals prescribed and notified. For them, rule 6F prescribes books of account, which says cash book, ledger, and journal if mercantile system follow, and documents prescribed are vouchers, evidences for the receipts issued as well as the expenditure incurred. For a medical practitioner, daily case register and inventory register are required to be also additionally kept on record. Now, for section 44AA subsection 1 says go to rule 6F. Then rule 6F says these are the cases you will have to maintain. However, when the gross receipt from the profession in any of the preceding 3 years have not exceeded 1.2 lakhs, or this is the first year, the gross receipt of the current year likely not to exceed 1.2 lakh rupees, then these books are not required to be maintained. This threshold being less, whereby no need to maintain, is mentioned in the rule 6F as far as the specified or notified professionals are concerned. Now, subsection 2 deals with non-notified professionals and business cases. Now, we'll take up books of account prescribed, class 11, subclass A. Question says whether books of account prescribed. That means only for auditing these 11 professionals, we will have to say yes. Very strangely, in few cases, the TAQRB noticed that for even a company will not come under notified professional, it will come under business or other professional. Therefore, class 11A, it was filled as yes, which in the opinion of TAQRB is not appropriate. Now, books of account, only cash book, ledger, journal. Cash book is defined to mean in rule 6F itself a record of all cash receipts and payments kept and maintained from day to day and giving cash balance in hand at the end of each day or end of a specified period not exceeding month. Today in electronic era, every day we get the cash book. So the cash book, ledger, and journal. Daily case register for a medical professional is not a books of account. It is other records, but it is also mentioned as books of account in some of the reports. Very interestingly, if you see, bank book is not prescribed. It may be maintained by us, audited, verified by us. But when we do audit of these 11 professionals, books of account prescribed, bank book will not come because it's only cash book, ledger, journal alone would come. For a medical professional, we'll have to take up only the inventory part of it. Daily case register is only an information or other document. It will not come under books prescribed. Now we'll come to subsection 2. Other than these 11 specified or notified professionals, all the professionals and all businesses put together, for all of them, subsection 2 says these people should maintain such books. They are not prescribing the books of account. they should maintain such books which would enable the assessing officer to compute the total income of the SSC properly in accordance with the Act, provisions of the Act. That means such books which would enable the assessing officer to compute the total income of the SSC under the provisions of this Act. That means it will vary from case to case. One would not be able to give an exhaustive list. But when the exhaustive list, but when the books are required to professorship path somewhere in the February, definitely would work in the recent path somewhere in the February and March. For people have followed other for also 44 and some other non-moving maintenance cases, also some cases not filled information of the basic information of report and why should be of balance sheet should not be started coming, but it is a problem to have a cut this condition it's any of us is leading and the income of it's discussing income of the SSC
Sir, am I audible? Sir? Hello.
Echo is there. Yes, now okay. Selva.
Yes, sir. I'm just checking with Ramnath, sir. He has some connectivity issues, so now he's rejoined. Just with him, sir. Sir, am I audible, sir?
Yeah.
Okay, I'll give you the presenter right, sir. You can continue, sir. 1 minute. And you can turn on your video too, sir, if possible. Yeah, your browser page is visible now, and just navigate to PPT, sir. Yeah. Yeah. The same page for last 40 seconds or something, it got messed up, so you can continue from this.
Okay.
Thank you.
My apologies for the inconvenience.
No issues. And
Now coming to the class 11 subclass B, dealing with books of account.
sorry, in slideshow mode, if possible. Sorry to interrupt, sir. Thank you, sir.
See, now in that scenario, the location of the books of account, in which of the locations books are maintained are required to be reported. In some of the cases, it is not found. And if the books of account maintained in a place other than registered office, then we will have to ensure that in case of a corporate entity, necessary forms have to be filed with the Ministry of Corporate Affairs. We'll have to ensure that the form has been filed. If it is not there, we'll have to inform the management that it's not appropriate in the company's perspective that books are maintained in a different place, but it is not reported to the Ministry of Corporate Affairs. And one more important aspect is books of account maintained under computer system, and from where we are able to generate printouts, etc. What are the books maintained under a computerized system? That is required to be separately reported. In fact, the schema comfortably doesn't enable us to provide it. Therefore, it was suggested that at least when we are issuing a manual report, this could be added. But having a separate report for the purpose of uploading, another report for the purpose of giving to SSA, etc., really will be time-consuming, Herculean task. And if the schema provides for it, is all the more good. When the books of account maintained in a computerized system, and it is kept in a server-based system, server may be physically located or it is in a cloud, etc., then we need to say the location of the server when the accounts are taken up on a ERP system. These are all certain observations TAQRB had noticed with reference to class 11 subclass B. Third, that is subclass C, talking about the books of accounts examined. Very interestingly, here not only books of account, other documents are required to be mentioned. So books of accounts and other documents are required to be mentioned here. So now books of account we are comfortably able to say. What is other document? The document which we see in order to establish the correctness of the amount specified in the books of account. The underlying documents evidencing the events taken place, like invoices, payment vouchers, bank statements. Sometimes primary documents would be this. There will be secondary documents we will see to cross-verify. TDS returns, GST returns, all that we will see. So the list could be very lengthy. One has to somewhere condense it. But at least certain primary documents which is generated during the course of carrying out transaction, that has to be called out. With reference to secondary documents, the list can be long, but at least primary documents have to be mentioned. Merely saying etc. would not serve the purpose. And secondary documents, one has to apply the mind and to say where to stop. One can continue to add on and on and on, but somewhere one has to make an end to that. Now we'll come to class 13. Class 13, subclass E, talking about adjustment relating to ICDS. See, there are two things. 13E talks about quantum, 13F talks about disclosure. Now, quantum, when the accounts are drawn up in such a fashion that the ICDS principles are not followed, ICDS requires an adjustment to be made. In which case we will have to say, because of the adjustment, how much is the profit getting increased, how much is the profit getting decreased. Many of the cases it was observed by TAQRB that they are left blank. In order to have a comfort of whether we have done things properly, better to say nil or zero whenever things are not applicable. Otherwise, it will give an image or impression that we have not consciously attended to it. And especially when accounts are drawn up following the exclusive method of reporting the purchases, sales, inventory, necessarily ICDS 2 gets kicked in, therefore some reporting is required. Ultimately it may become zero, but at least quantification is warranted. Now coming to disclosure, whichever is the ICDS applicable to SEC, for that ICDS, out of 10 ICDS, 8 ICDS require the disclosure to be made. Applicable ICDS, disclosure is necessary whether or not an adjustment is warranted in the statement of total income. So ICDS 1 talks about disclosure of accounting policies. That means these 10 related ICDS, 8 is only required to be disclosed, remaining 2 is not required. So therefore we will have to say disclosure is required to be made. Whatever we can cross-reference it to the class 18 of the tax audit report relating to fixed assets, etc. But a disclosure is required in the form of a separate sheet, and which has to be appended along with the notes forming part of the financials, etc. We have to make the disclosure because space may not be sufficient to have accounting policies, etc. Merely because the adjustments are not there for ICDS, one should not take a view that disclosure is also not there. Disclosure is necessary. Some of the cases, and under 8 ICDS, some disclosure can be cross-referenced with certain other classes of the ICD, financial statement, etc. But some disclosure has to be made. And what was observed by TAQRB was disclosure was not made. Disclosure was made only when there is a deviation. In a case where there is no deviation, no disclosure was made. And sometimes peculiarly, disclosure was made to say it is given in an attachment, but the attachment was not there when it is got uploaded, missed out, etc. But still, when we say it is given as a separate attachment, it is ideal to ensure that the attachment is added to this. Inventory, class 14A and 14B, talking about inventory. Method of valuing inventory. What the form requires is for each item of inventory, raw material, finished goods, WIP, independently we will have to say which is the method of valuation of inventory to be mentioned. It is not that for whole inventory only one method is getting reported. Each class it has to be separately reported. And there are cases where very few number must be reference is made to a separate attachment given, but of course that attachment was not found. One should ensure that though we have done enough amount of work in preparing a separate attachment, give fullest disclosure, having done all these things, if it's not getting uploaded, then it will give an image as if that we have not done the work, and therefore it is better to ensure that these sort of things are not taking place. Coming to 145A, adjustment required to be made when a case follows exclusive method of reporting purchases, sales, inventory. Companies are required to follow exclusive method of reporting. By and large, assessees would like to follow, other than companies also, would like to follow exclusive method of reporting the purchases, sales, inventory, so that it is possible for them to report the ITC outside the P&L in a balance sheet, and the discharge of the amount required to be paid through ITC, etc., can be represented separately. So 145A requires the assessee to follow inclusive method, failing which the assessee is expected to mention it in the impact of it in class 14B. So even for companies, certain audit reports, the deviation is not reported. See, our guidance note may say in one of the clauses, some para, that if the SSC is able to demonstrate because of this adjustment, ultimately the income is zero, fine. The SSC may claim it and it could be verified, it could be stated also, nothing wrong with it. But the amount of ITC required to be added to purchases, the amount of taxes collected on sales, amount of ITC or a tax component required to be loaded to inventory, we have to quantify and say, and especially in corporate, necessary books will be given under exclusive method, and therefore 145A adjustment are required to be given in class 14B, but in some of the cases it is found not so reported, therefore it requires attention of the members. Now, class 17, immovable property being land or building or both. It only talks about land or building or both. Very peculiarly, section 50C and 56(2) talks only about land or building or both, and it is not any interest in a land or a building. All the immovable properties are not considered. It is only land or absolute land or building or both. 50C was there in statute for a long time with so much of modifications required to address the current scenarios by providing some leeway, etc. Similar scenario came up in section 43CA as well for a seller perspective on a business note, and on a recipient side 56(2)(10) takes care of the transactions where the transactions are entered into at a price less than stamp duty value, subject to exceptions provided in those sections concerned. Very interestingly, when a person sells the property to his blood related brother at a price less than the stamp duty value, the recipient would be exempt from taxation under 56(2)(10) because he receives the property for inadequate consideration from a relative as contemplated in 56(2)(10), reference to 56(2)(7). But for the seller brother, 50C does not say, the provisions of 50C would not apply in case the property is sold to a blood brother. So therefore, what one has to see is, for the buyer of the property, 56(2)(10) may not get kicked in, but for a seller, 50C or 43CA cannot get escaped. That distinction has to be borne in mind. Class 17 talks only from the seller's perspective. Class 17 talks only from the seller's perspective. It is not talking from the buyer's perspective. There is a separate clause to deal with buyer's case. What is discussed is only for a seller's perspective. That's the first aspect we'll have to take it up. Now, as we mentioned at the very beginning, we are only taking up the information with reference to the books of account maintained. The assessee is in the real estate business. 43CA will be examined, and this information contemplated in class 17 of 3CD will be verified. Now, the assessee is not in a real estate business. He is only engaged in some other business. He has got in his business books certain immovable properties. Let us say an individual carrying one business. In his business books, he has got one immovable property, being land or building or both, and he transferred it at a price less than SDB. Then in class 17, it is required to be reported. Now, the same individual has got business for which books are maintained and produced for audit, and the very same individual's returns are furnished by the assessee with the help of the same chartered accountant. Now, the chartered accountant may come to know that outside the books of account, in his personal status, he has got one piece of property sold for a price less than SDB. Since it is not emanated, the information is not emanated from the books of account, in class 17, for that 50C transaction, auditor is not required to furnish that information. Assessee is required to incorporate that information when furnishing the return of income, but the auditor is not required to furnish that information in class 17 because it is not found in the books of account. For a corporate assessee, anyway, in the books of account, this will get reported, 50C will get kicked in. For an individual HUF where books of accounts are there only for business and shown for audit purpose, and the personal transactions not coming from the business books need not be reported. Now, when this transaction took place at a price less than the SDV, this clause requires for reporting. When the transaction is taking place either at SDV or more than SDV, reporting is not required. But strangely, in some of the cases where the transaction is equivalent to SDV or something more than SDV also, the reports contain information about the transaction. Probably by abundant caution it was reported, but the clause itself requires reporting only when there is a transaction at a price less than SDV. And interestingly, when the clause came, the provision of the Act did not have any leeway for transaction carried out at a price less than SDV by a percentage prescribed. Earlier it was 5%, thereafter increased to 10%. Last year to this year, May month or so, some small period to clear the inventory of the real estate industry, then became 20%. But all these things may result in assessee not getting taxed when there is a shortfall. The SDV is more, transaction value is less, but the gap is falling well within this prescribed percentage. The assessee may not be exposed for the deemed income taxation, but merely because the gap is falling well within this prescribed percentage, auditor cannot say the report cannot contain this information. Report is required to contain this information. Tax will not be levied considering the gap as the deemed income. The columns of clause 17 does not say when the percentage of gap is falling within 5%, 10%, 20% as the case may be. The reporting itself is not required. That is not there. Therefore, when a transaction took place less than SDV and it is coming under 43CA or 50C recorded in books, even if the gap is falling well within the prescribed percentage, reporting cannot be avoided. Now let us come to clause 18, dealing with quantification of depreciation. Now what depreciation? Of course, depreciation permissible under income tax law. There are many cases where the software of the private people being relied upon to compile this information, and whereby certain errors could not have taken place in reality, but some people still follow their own way of pulling out the schema and then start typing, etc., where certain type of errors are bound to be there. One case where one has to be a little more careful, especially when such type of dependency is made on the schema, etc. Now, one thing which was noticed was opening balance of the written down values shown in clause 18 for the eligible block of asset different from the previous year's closing balance of the clause 18 WDV. When private softwares are relied upon and it is doing this checking, this sort of errors could not have happened. But when people started manually keying and going depending on certain things, these sort of errors also may come up, which one would not have dreamt or would not have noticed. And these things are very surprising, but still one has to exercise that whether this is taken care of. And some of the cases where the TAQRB noticed that in case of date of addition, the additions were divided into two broad families, first half, second half. Many of all the additions coming under first half, a standard date, 30th September. Effectively speaking, it is not 30th September. For a non-leap year, it should be 3rd October because the language used is 180 days. And therefore, up to 3rd October, it is eligible for full rate of depreciation. After 3rd October only, it will be half year depreciation, half of the normal rate. But TAQRB noticed that invariably all the cases, it was mentioned as 30th September. The second part of it, 31st March. Which by itself would go to say the information is not properly vouched, verified with records, etc. And the date of acquisition and date of put to use. Sometimes some segments people misunderstand and start keying in the data, and therefore one has to be a little more careful about it. Date of acquisition and date of put to use. We have to be careful. There are occasions where the assets might have been acquired on the very same day, could have been put to use, like printer, computer, cell phone, etc. Nothing prevents. But there are certain type of assets which would require some time to get it ready for use. that factor has to be taken care of. But there is one case where I personally saw in our own office, where the accountant of the concern for a building WIP, whenever the materials purchased and before the end of the financial year, building got capitalized. So he has taken every entry on the date on which the material purchase he has capitalized for the purpose of tax audit. Cement purchased on the very same day, sand purchased on the very same day put to use, and steel purchased very same day. And that was the first year I was carrying out audit for that concern. I called the accountant and said, what made you to write like this? He said, sir, whenever the cement comes, on the very same day we started using it for construction. The building might be getting ready after some point in time, but the cement is put to use. Similarly, the bricks are put to use on the very same day. So therefore, why should I wait for the entire building to be ready for use? Therefore, I am capitalizing on the very same day as put to use. A misunderstanding about the law and what the law expects it to be. But when volumes are more, it is essential to ensure that one is taking care of this. Thereby, at least these sort of errors are not taking place. And date of deletion, very important. Many occasions it is seen that the importance is given for the date of addition. Equal importance is not given for the date of deletion. Some dates are put, 31st March is put. This is where the TAQRB has noted that one has to be a little more careful in following this also. Now, one important aspect on a practical note, slightly deviating from this proposition, we'll have to say, generally, the tendency to give date of addition is only for an asset capitalized. When asset is kept in WIP, the tendency is to give it only in the year in which it is capitalized. We'll hold it till the year it is getting ready, and thereafter in the year of getting ready, we'll give the date of acquisition, date of put to use. Now what happens, we have a provision of accelerated depreciation in the income tax law under section 32 subsection 1 clause 2a. What does it say? An eligible SSE carrying on business and the assets are not disqualified assets, it is eligible for an accelerated depreciation of 20%. Now this is in addition to the normal depreciation otherwise allowed. It gets added to the normal depreciation. Therefore, when the asset is put to use for a normal use on or after 3rd of October, the normal rate of depreciation is 15%. Since it is put to use in the second half after 3rd of October, it is charged only at 7.5%. When the assessee sought to take the benefit of accelerated depreciation in respect of that asset, instead of 20%, only 10% was given because it is put to use for less than 180 days. In the assessee challenge, certain rulings went on to say the purpose of this law is only to give benefit to people who are acquiring new assets. For a person who is acquiring in the month of September, you are giving 20%, but the person who is acquiring on 5th of October, you are giving 10%. He doesn't get the benefit of accelerated depreciation in full. Why not we allow balance 10% in the subsequent year? And this particular view of the judiciary got endorsed by the amendment in the law also. So law also got amended to enable that assessee to claim this benefit in the next year, balance 10%. Now, if you go to the form, we put the date of asset put to use and date of the addition as the current year, and moment you fill up current year, it will take only half of the rate, current year and next year, half of the rate depending on the date. If the WIP is put in the year of its acquisition and its put to use is given in a subsequent year, then the accelerated depreciation data will fit in properly. So for the better interest of the SSE, even all the WIPs otherwise eligible for an accelerated depreciation, etc., ideal to put it even in the year of acquisition with the date of put to use as 0. That means not yet put to use, but date of acquisition has to be captured so that in the next year when it brought forward, moment the date of acquisition falls in an earlier year and put to use in the current year, we'll get the numbers properly plugged in. One more aspect would be the restriction in the rate of the depreciation. An asset is put to use for less than 180 days, half of the normal rate is allowable. we carefully see the proviso below section 32 subsection 1 clause 2. It says an asset is acquired in a financial year, in a previous year, and put to use in the same financial year, same previous year, then the half of the normal rate would apply. Let us take a scenario where asset is acquired in year 1, let us say February, but not put to use. But it is put to use in the subsequent year on November. For some technical reasons, it could not be put to use immediately thereafter. So in the subsequent financial year, only in the month of November, the asset could be put to use. Now in the second year, when the November month it was put to use, we start plugging in the information in clause 18. Since the date of put to use is given as November, the system will automatically allow depreciation half of the normal. But the proviso says when the asset is acquired in the financial year and put to use in that financial year for a period of 180 days or less, then half of the normal rate would apply. The asset is acquired in year 1 and put to use in a subsequent financial year, the restriction of half of normal rate will not apply. Full rate of depreciation would be eligible. But how will we be in a position to ensure that we are entitled for this full rate of depreciation? If you give the addition data only in the year in which it is put to use, the system will pick up, in this given example, November as the date of put to use, and system will give only half of the normal rate. But if the WIP is captured in the year in which it is taken as WIP, and you bring forward the WIP in the subsequent year filling up of forms, for opening WIP, it will ask for put to use. Moment it is put to use one day in whole financial year, a full rate of depreciation will be eligible. In the given example, February month we say WIP but not put to use. First year is over. Second year we bring forward the data. Now for the assets kept as opening WIP, not included in the block, each type of asset we go and put the date as of put to use. Any date in that financial year, April, May, November, December, March, full depreciation will be allowed for the previous year acquired assets but put to use in the current year. For that reason, at least the SSC in its own interest should furnish the details of the WIP of the plant and machinery, and even though it is not capitalized, whereby this benefit would not be lost in the year in which it is subsequently put to use. And accelerated depreciation would be available only in respect of certain eligible assets and eligible SSC. So there are occasions noticed by TAQRB, but other assets as well, the accelerated depreciation was sought to be claimed, which is not in accordance with the provisions of law. The next provision is with reference to clause 20B. Of course, our literature as well as the several meetings which we have attended to, some novel SSCs and councils used to ask this question. Clause 20 small b talking about due date and actual date of remittance of employee welfare funds like PF, ESI. What is the due date as per the statute? Clause 20b says due date, the amount recovered, due date under the respective statute, the actual date of payment, and the amount actually paid. Some initially 36(1)(5) said if you do not pay within the stipulated due date of the respective statute, it will be permanently not allowed. Similar was the scenario for 43B in respect of employer contribution. Law was considerate enough to say employer contribution would not be hit by that provision to that extent. It will be at par with the remaining clauses of 43B, even if it is paid within the due date of the under 139(1), it would qualify for benefit. And we have Gujarat High Court judgment, Kerala High Court judgment, and the recent Madras High Court judgment went on to say employee contribution could not be considered at par with employer contribution. There are other judgments of Karnataka High Court, Delhi High Court, etc. to say, Punjab and Haryana all to say the employee's contribution could also be considered at par with employer contribution, because moment you collect the money by virtue of section 2 clause 24 subclause 10, it becomes the income of the SSC. Whenever the remittance is made, it is SSC's expenditure claimed against SSC's income. So that means, as notwithstanding anything contained in section 28 to 43, 43B will override 36(1)(5)A. Therefore, 43B, as long as the payment is made within 139(1) due date, it will qualify for the benefit, is what other High Court judgments went on to say. Of course, we had, interestingly, Finance Bill 2021, floor of Parliament, Honorable Finance Minister said, we'll have a clarificatory amendment to say employee contribution would not be considered at par with employer contribution under 43B. Now the question interestingly arises whether the amendment made by the Finance Act 21 could be considered as retrospective, whereby all the earlier appeals filed would also be hit by that. We have in the month of May 2 Hyderabad tribunal judgment to go to say the amendments are prospective only, and therefore it will not hit the earlier cases wherever appeals are already pending. Depending on the jurisdictional High Court judgment, one has to consider. But some assesses, because CPC always takes up this due date as per the respective statute furnished in the form number 3CD and start making additions, and assessees have to again and again file an appeal. And therefore, some assessees adventurously started saying that the due date as per the respective statute, why not we put 139(1) due date for all the 12 months? April, May, June, July, August, September, every month. We'll put the due date as 139(1) due date, so that within the due date we have paid, therefore the system will pick up. TAQRB noticed this in some of the cases, but very, very dangerous proposition. Now, one can say we can persuade the SC not to take that adventurous position. That is not appropriate. You can furnish the information and thereafter litigate. But giving an information for due date under the respective statute as 139(1) due date is very adventurous. Now, if that is the way the assessee wanted the form to be furnished, necessarily the auditor has to draw attention of this particular proposition given by the assessee in para 5 of 3CB or para 3 of 3CA and say, in the opinion of the auditor, it is not appropriate. TAQRB, as the members of the TAQRB, whenever they addressed very many places, said from auditor's point of view, we should not take up that position. We have to say assessee takes up this position and therefore assessee furnishes like this. But without giving any comment, just endorsing it would land up the auditor in trouble, because the primary information required to be furnished as per the provisions of law is not properly furnished. If the assessee chooses to give information under that clause, due date as per the respective statute, like 139(1) due date, that has to be very seriously taken note of. Then penalty, clause 21A. There are three different information contemplated in law. One is penalty for infraction of any law. Second is any other penalty or fine. Third one is expenditure incurred for any purpose which is offense or prohibited by law. Now, first one let us appreciate. Expenditure by way of fine or penalty under any other law or in infraction of any other law. Now, what TAQRB noticed in this case was one different legislature assessee has suffered penalty or fine. Legislature wise, it has to be furnished. PF Act is the penalty paid. GST Act, penalty paid rupees this much. Aggregating everything and giving consolidated amount as penalty is not appropriate. Furnishing a detailed information is warranted. So, if the assessee did not follow a particular legislature or the provisions of law, and that has resulted in consequential penalty, that has to be mentioned. Penalty for infraction of law. Now, coming to second category, penalty, any other penalty or fine. I only wonder, how can there be a scenario of any other penalty or fine which is not for infraction of law? If it is for infraction of any law or rules or order, etc., that will come under the first category itself. Any other penalty or fine, what it could be maximum, should be not a penalty for infringement of a law, for infraction of a law. It could be a contractual penalty. In other words, a penalty for violating the contractual obligation. That could be any other fine or penalty. But we have a number of judgments to say, Ahmedabad Cotton Manufacturing Company Supreme Court, and thereafter followed by several other judgments to say any penalty for infraction of or violation of the contractual obligation is, though titled as fine or penalty, in the eyes of income tax law, it is not an inadmissible item. See, let us say, for example, I've entered into a contract to supply goods and I'm unable to supply on a specified day. Therefore, the other person says, because of you not supplying on that day, my consequential planning got disturbed. I have incurred some losses. You have to compensate me. So it's a violation of the contract. I am unable to supply on a particular day as agreed, for which I am paying liquidated damages. This is nothing but penalty for violation of contract, not violation of law. This should not lead to disallowance. Though the language used in that clause is any other penalty or fine, one may contemplate this being required to be reported. I have my own apprehension that if we report it, whether the schema would pick up and compare with the computation of total income and say, hey, the auditor has given in his audit report that this is any other fine and penalty, but we did not find the same as disallowed by the SSE in the computation of total income. Therefore, suo motu, we would start making addition under 143 subsection 1 clause A subclass 4. We do not know, we'll have to experiment whether that could come or not. But other than penalty for infraction of law, what else could come? In a second category, I have my own doubt whether anything which would be otherwise disallowable can be placed here. Is something which one has to really experiment. Anything which is not disallowable, if you place it here, then we do not know whether suo motu it would be picked up for the purpose of disallowance and ASCII has to face the music. Therefore, if it is any other penalty which is not for infraction of law, ideal not to report it under this clause. So first case, penalty for infraction of law. Second case, any other penalty or fine, but as long as it may be classified as penalty in the books of account, but as long as it is for infraction of a contractual obligation, better not to report it. If it is reported, then it may lead to disallowance. That may or not be, we'll have to verify, and why should one take the unnecessary risk. Third category is something very carefully to be approached. That is verbatim the requirement of explanation 1 to section 37. Expenditure incurred for any purpose which is offense or which is prohibited by law. The first one and third one are on a different footing. First one, what we have seen, expenditure for any infraction of law by way of fine or penalty for infraction of law. This is on a different footing. Expenditure for any purpose which is offense or prohibited by law. Both are on a different footing. Let us take, for example, the first category, whatever fine, penalty for infraction of law. The fine or penalty imposed after the infraction of law takes place. That means fine or penalty is in consequence of the offense being committed. But the third category is slightly on a different note. What does it say? Expenditure for any purpose which is offense or which is prohibited by law. That means before committing an offense, the assessee incurs an expenditure for the purpose of committing an offense. Very, very difficult to contemplate in real life scenario. A person would do that and also go to the extent of documenting in the books of account. A person has got a competitor and he doesn't want that competitor to compete with him, at least for a temporary period, to see that a very important contract is secured. And therefore, he approaches an underworld personality and to take this competitor outside business at least for a month, so that kidnapping takes place. So that within that 1 month, he will stabilize that activity and see that he comes up. Now, that expenditure paid to your don for kidnapping a rival is an expenditure incurred for a purpose which is offense. That means this expenditure is incurred prior to committing the offense. That only will come here. But unfortunately, the distinction between first and third category by and large is not noticed. Any fine or penalty is sought to be brought under this explanation, but that is not appropriate. Therefore, the third category, very rarely it is going to happen. One should not put up any number on that. Even if it is so, whether the SSE would write that in the books of account and we will come across such type of events, doing or making payment for the purpose of committing an offense, whether that would be found is something very rare to happen. So therefore, under third category, we'll have to be very careful that unless actually such things are happening, amount should not be filled up. And interestingly, we have one judgment where the managing director of the company got kidnapped and the company has paid money to release him. And the officer sought to introduce this explanation 1 to section 37 to say, we will not allow this as a deduction, and where the SSC went to the extent of arguing to say, we have not paid money for kidnapping. We have paid money for releasing the person who has already got kidnapped. Our managing director traveled in the discharge of his responsibilities as an employer on a working day. During the period of his travel, he got kidnapped, and therefore it is duty of the company to release him. What we have paid is only to release him, not for kidnapping. Therefore, our expenditure shall not be required to be disallowed, and the tribunal appreciated the distinction and allowed it. And therefore, that third category would generally not be available. Ignorantly, one should not put any number on the third category. Then amount inadmissible under 40A, 1, 1A, 2, 3, all. One important aspect here is payments for residents and non-residents are to be separately given. Party-wise details required to be furnished because name of the person, permanent account number required to be informed. Aggregation of all the cases into one basket and furnishing information not appropriate. And date on which such payments were made without deducting tax, date on which or the amount given. Again, random date giving information on a consolidated basis not appropriate as far as this particular class is concerned. And contingent liabilities. Generally, contingent liabilities are not provided in the books and it is given only in the form of notes. And if a contingent liability, being a contingent liability, is already provided, the accounts could not be said to be showing true and fair view because the degree of provision would not have attained. So, if the contingent liability is given in the notes, it is not debited to P&L account. Class 21 takes only about a debit to P&L. So, therefore, a contingent liability given in the notes on account is not required to be provided in class 21G. But there are occasions where the provisions made, year-end provisions made for wages, salary, rent, etc., were also ignorantly reported inadvertently, not ignorantly. I'm sorry, I should not have used that language. Inadvertently, that provisions made in the books, year-end provisions are reported under that 21G, which is not appropriate because it is not contingent, it is crystallized one. Only payment is postponed. Therefore, that would not come under contingent liabilities. 40A2, class 23. Name and PAN of each person was not given. That means for each person to whom the payment is made, name and permanent account number as far as possible to be provided for. And there are cases where for that one person, if more than one type of service is rendered or one type of supply is made, the payment made to him got aggregated and then furnished. Different supplies are there, different services are there. One has to make it clear and see that it is given distinctively. Then the related parties, 40A2. The related party as contemplated in 40A2 different from AS 18. So we have to see, we are giving the related parties information, only those related party transactions covered in section 40A2. Not all the cases, only those cases which are covered under 48. And in related party transaction as contemplated in AS 18, we will give both the debit side and credit side of the transaction. But in 40A2, what we need to consider is only the debit side. That means only the payment part of it. The receipt part of it from the related party would not get triggered or would not get considered for the purpose of clause 23. There were some occasions where the services received, the sales made, services rendered, found in the credit side of the P&L account, reported in AS 18 disclosure, were also given in 40A2, which is not warranted. So one has to be a little more careful about it. Because those days when these credits and the debits put together crossed 5 crore rupees, the case got selected by the system for referring to domestic transfer pricing. The debit side of 40A2 alone, if you consider, the limit was less than 5 crore. For SDT transaction, those days the limit was 5 crore. Thereafter, 40A2 got removed, only the AET, IA, IB, IAB, etc. picked up. When 40A2 was one of the provisions available in SDT, in addition to giving 40A2 for the debit side, since credit side was also factored and counted, the case was unnecessarily got picked up for SDT verification and referred to transfer pricing officer. Appearances have to be made before the transfer pricing officer to say that the provision itself is not applicable. But since the reference was already made by the AO, the time limit got extended. And the TPO said, if I say there is no reference necessary, assessment would get invalidated because it is passed after the stipulated time. Therefore, he continued to have the reference and he made order saying all these things. Then the extended time was sought to be availed of, etc. Therefore, one has to be a little more careful to say only the payment part of or the debit side of the P&L account one has to consider for the purpose of 48.2, not the income side or the credit side of the P&L. Class 41 or class 25 talks about profit chargeable to tax. Now 41 subsection 1, 2, 3, 4, 5 all fundamentally presupposes the fact that a deduction was already claimed, and in respect of that, either it could be a deduction towards allowance or a deduction towards an expenditure or a trading loss. Now if it is claimed and subsequently the assessee receives any benefit by way of remission or cessation, or he receives any amount, in that case 41(1) would get triggered. So what needs to be seen is previously deduction should have been obtained and tax, either tax or advantage should have been obtained. If previously it was not a tax deduction, reversal of it would not require to be reported here. Simply principal waiver of a term loan. But at the time of borrowing term loan, no deduction was obtained. Therefore, principal waiver of the term loan is not required to be considered under 41. And a doubt arises where the assessee has already considered in the credit side of the profit and loss account as sundry balance written back. Previously, deduction was claimed and therefore liability was there, and that liability no longer payable. Therefore, it is returned back. Even if it is credited to P&L, whether it is required to be mentioned under 41. Class 25 does not say amount not credited to P&L account. Therefore, our institute guidance note makes it clear that even the sum is already credited to P&L account, it is required to be reported by the tax auditor in class 25. Class 26 talks about 43B. Fairly, by and large, no great observations on this, excepting one doubt coming again and again on this principle. When the assessee follows the tax collections and remittances as balance sheet item, not P&L item, considered it as balance sheet item, and something remains unpaid on the balance sheet date as well as on the date of furnishing the return of income. Whether one should invoke 43B clause A, tax, just duty by whatever name called, whether that clause would get applied, or since it is not claimed at all in the P&L account, payment thereof would not get hit under 43B. That's a question again and again comes up. Saurangi Sales Bureau case, Honorable Supreme Court in 1979 said, your way of presenting it in the P&L account or balance sheet doesn't make difference. Tax collected is forming part of business receipts. It is part and parcel of your trading receipts. So it is nothing but part of your trading receipts. Payment thereof is your business deduction. You might be showing it in your P&L account collection and remittance, or you may be showing it as a balance sheet item. What is shown in the balance sheet as a collection should be presumed to be credited in the P&L account, and what is shown in the balance sheet as assets, liability side payments presumed to be debited to the extent not paid, a debit to P&L and a corresponding provision payable. If that payable is not made before the due date of furnishing return or tax audit report, a disallowance is warranted. So merely because the assessee shows this as a collection and payment item, one would not be able to say this is not required to be shown. It has to be necessarily shown. Honorable Supreme Court in Saurangi Sales Bureau case made it very clear that it is to be treated as part and parcel of the trading receipt. Payment thereof will be entitling the assessee to seek the deduction therefore. Class 27, SENVAT related information, another doubt. What does it say? Earlier form said ITC relating to SENVAT. The original notified form says SENVAT. It doesn't talk about GST ITC, but the schema which has come up in the electronic form uses the language GST ITC as well. Therefore, a doubt arises whether we have to restrict only to SENVAT, if any, and GST ITC is not required to be reported, or we'll have to take GST ITC also in the place of SENVAT because we have already crossed a couple of years after the introduction of GST. Of course, our institute has clarified that it is for the assessee. If the assessee would like to give GST, fine. If the SENVAT alone is given, also nothing wrong in it. But additionally, that clause says how is it treated in the P&L account and balance sheet, how the closing balance is shown, how that credits and debits are treated in P&L. That information is found missing. We are giving table, etc., but that information is missing. How it is reflected or treated in the P&L balance sheet is required to be mentioned as a note. That is missing, and all the more this need to be cross verified with 145A. Whatever information coming under 145A and this SENVAT or GST ITC, if the assessee chooses to furnish GST ITC, this to be cross verified with 145A and proper number have to be presented. Coming to class 31, loan or deposit, there are occasions where people have furnished consolidated figure instead of giving it party wise, and certain columns are not filled up. The law requires for each borrower or each depositor or each person from whom the assessee borrowed or repaid, name, permanent account number, the balance, current year transaction, and the maximum balance, whether squared off, etc. All that requires to be furnished. So therefore, consolidated figure is not appropriate. One should not go to the extent of furnishing a consolidated number. And of course, when 269 ST comes, then all the more the issue gets further taken up for further discussions to say law requires under 216 ST only the money received. Money given was not contemplated, but the form requires the information relating to payment also. Therefore, one has to give that payment, even though the law does not contemplate any violation from the payer's perspective, but the department may get that information to verify with the payer's side. Class 32A talks about loss or depreciation brought forward and assessment details. What was observed was the assessment related information, like section under which the assessment order was passed, date of the passing of order, and document identification number, all was not properly filled up. And there were occasions where what was furnished in the previous year audit report and the current year audit report, there was a mismatch, even though there is nothing tangibly moved from last year to current year in respect of those years, but still something went wrong. Probably previous year there may be some typing error which might have got corrected in the current year. Any one year is wrong, the other year can be said to be correct. To correct the mistake, some errors could have been rectified, but still on an apparent review of the preceding year and current year, one may feel that what was furnished in last year column, maybe 2 years before, brought forward loss and depreciation, that something is not matching with the current year information in relation to the same year, which could be an avoidable one by proper verification of the information. Then comes section class 34C, TDS and TCS related interest under 2011A and 206C7. It says the amount of interest and the amount of payment of interest and the date of payment. That is where the problem. One can quantify section under which we are ascertaining the number as well as the interest amount. How much was out of that paid and what date was paid. The details of the date of payment and the actual amount paid was not found in some of the cases, which need to be cross-verified by verifying the portal, pulling out the information of justification report, etc., and then it has to be properly furnished. Then coming to inventory, there are two things for a trading case and manufacturing case. For a trading case, there are cases where closing inventory for that particular trading item was 0. Therefore, no information about the inventory movement was furnished: opening stock, current year purchases, sales, closing stock. Because closing stock is 0 for the traded item, purchases and sales cannot be said to be not required to be given. Therefore, movement has to be furnished even if the closing inventory of a traded item is 0. For a manufacturing case, yield percentage is not furnished. Many occasions, the SSC finds challenge in furnishing this information. If at all so, a proper qualification in form number 3CA para 3 or 3CB para 5 required. If the yield data is not furnished, nothing wrong, but at least a qualification from auditor side in para 3 of 3CA and para 5 of 3CB necessary. At least that should have been taken care of. Class 40 ratios, sale of scrap. Our institute guidance note says sale of scrap should be considered part of turnover for the purpose of various ascertaining turnover for tax audit purpose. Now, in the financials, sale of scrap is shown as a separate line item. When furnishing information of the turnover, this is not aggregated. That has been found in the PAQRB's review. And net profit before tax is what is required to be shown. When some of the cases, PAT was shown, net profit after tax was shown. And for manufacturing cases, material consumed over finished goods produced, that information was not furnished. And of course, qualification in 3CA or 3CB or 3 or 5 of respectively was also not found. Either information is required to be furnished or at least qualification is required to be given in the relevant classes. These are all certain aspects dealing with information. When we are verifying the information filled in by SSC, certain errors observed. The other segment would be inconsistencies with information found elsewhere. What are the inconsistencies? Class 2, address of the SSC. There is a case where PAN has got one address, database has got one address, but the address found here is different. There could be logical reasons, very valuable reasons also as to why there should be a difference, but ideal to synchronize it. Ideal to synchronize it so that it will not look as if things are not in order. Annual report of a company, MCS portal, contain address that is different from the address given in class 2. Again, in the annual report, some address could have been there and subsequent changes. Better to synchronize and give it. Indirect tax registration numbers. Class 4 requires indirect tax registration number or identification number. Now, in CARO, certain indirect tax related disputes are mentioned. In these indirect taxes, there are disputes. But those indirect taxes, the registration numbers are not, or identification numbers are not given in class 4. That is something found to be odd. So the company has certain indirect tax registration or identification number. It has got certain disputes. Those disputes are given in CARO. But in class 4 of tax audit report form number 3CD, those indirect tax registration or identification numbers are not found. That has to be synchronized appropriately. Then there are certain indirect tax registration numbers like IE code, etc., or PAN based, GST, PAN based. Very interestingly, in some of the cases, PAN given and this indirect tax registration number based on PAN, there's a difference. So that is something odd. So when PAN based indirect tax registration numbers are found, that has to be checked whether there is a reason why there's a difference between PAN. Probably an amalgamation and subsequently registration number, a post amalgamation, etc., could not have been amended, etc. Valid reason could be there, but still better to reconcile it whether it is an error or it is with valid reason, where PAN based numbers find a change between or a difference between PAN as well as PAN based indirect tax registration numbers. And coming to depreciation, cross verification, and what problems cropped up apart from filling up the columns, what problems cropped up as far as the depreciation is concerned. Additions total as per the financial statement, addition given in class 18, there is no match. There's a difference. And one can cross verify the deletion also. In case of corporates, the same gross block removed, depreciation removed, profit on sale of asset, if we link it, the sale price also could be cross verified. There is a mismatch with reference to that number in the financial statement. There is a column in class 18 to say exchange fluctuation insofar as it applies to section 43A. That is money borrowed in foreign currency, assets acquired in foreign currency. For repayment of that money borrowed, fluctuation takes place. That fluctuation difference should not be charged to P&L. It should be added to the cost of the asset, or it should be reduced from the cost of the asset, being favorable, unfavorable position in financial in the foreign currency account. In that case, it has to be separately mentioned. The corporate notes contains the information relating to the money borrowed in foreign currency, repayment made, fluctuation, etc. But class 18 of the tax 3CD does not have anything information relating to this information. Therefore, when somebody cross verifies, there is an error appearing prima facie, which is something one has to cross take care of. The next is Msme. Generally, for a non-corporate assessees, the Msme would be very rarely figured out and presented, but if there are substantial delay in making payment, we'll have to see that the non-provision of interest payable to Msme would go to the extent of calling for a qualification in the audit report itself. But in a corporate entity, at the time of doing statutory audit, this exercise should be done and it will be taken care of, whether a provision is warranted or a note is warranted, etc. If provision is made, when the financial statement contains a provision made for the interest payable to Msme with details, class 22 of form number 3CD should also have the same information. In the financial statement, it is found interest payable to Msme provided, but in class 22 of the tax audit report form 3CD, it is not there. This is required to be cross verified and presented appropriately. Then class 23 form 48(2), what is given as payment made to specified persons in application of section 48(2), at least to that extent it should match with what is given in class 23. If there is an inconsistency for the payments itself, then one has to make it very clear. That is something which is noticed. Profit not chargeable to tax in financial statement was there, but in the class 25 it was not there. Similarly, class 27. Loan or deposits, class 31, numbers are not matching with financial statement. Class 34A, our TAQRB's observation, we'll have to look at slightly carefully. The amount shown under the head salary, under the head rent, under the head other charges, what is debited to P&L account and what is shown as amount, total amount, out of which how much is liable for TDS we carve out. First we say how much is total of that nature, may not be liable to be TDS, but still we'll have to quantify that in the first column. That number is not matching with the amount given in the financial statement. Now what will happen, supposing for some reason certain capex are incurred, but which are in the nature of this item, like salary or contract, work in pursuance of a contract, rent paid for an asset which in the books of account capitalized for some accounting reasons, it will appear prima facie the numbers are not matching. So though there is no compulsion, after reading this observation, what comes to my mind, anything in P&L will give in one line, rent, salary, etc., to match with the figures. Anything in balance sheet will have another line for the same nature of payment, like salary, but found in the balance sheet, rent found in the balance sheet. What is charged to the asset of the same nature, 194C, 194I, will give a separate line item, so that person reading that will say, okay, this is at least matching. The other one we can give a note. The separate line is given for matching with the financial, or a separate reconciliation statement added would solve the problem. But adding another reconciliation statement and furnishing along with 3CD may not be required one, that at least bifurcating like this and working out and keeping the numbers may help the SSE to defend the case better later at a later point in time. Class 35 inventory trading as the nature of activity chosen in class 10 of 3CD, but no inventory details about trading was furnished and no qualification was shown in audit report 3CA 3CB is what observed. We have scenarios where we will rely on MRL, management representation letter, and we'll complete the audit. When we do so, para 3 of form number 3CA, para 5 of 3CB, we are required to state that in respect of those classes we have relied on MRL, and our test checks are based on that. 40A3, 40A3A, cash payment we can verify. Some of the cases even open checks we can verify. Crossed check or account payee crossed check. Since the checks are not made available, banks are holding it, not given to SSE, very difficult. Therefore, we are relying on the management representation letter. Class 21D, we have to say that aspect. 269 SS, 269T, 269 ST, class 31A to E, we will have to state we are relying on the management information. On the contrary, we say the SSE has not, we are not having information, therefore we say the SSE has not borrowed money through account payee, it will call for penal consequences. At the same time, we say he has borrowed only through account payee, he has paid everything only through account payee, we are not comfortable. Therefore, para 3 of form 3CA or para 5 of form 3CB, we will have to make a reference of this MRL in, so that we are able to see this. Then class 21B also 40A1, 40A1A, not 40A1, typically 40A1A. Sometimes the SC may say, sir, the other person has disclosed this in his total income. It is only a matter of time. I will get, he also requires his return to be filed and get a certificate from the auditor. I doubt whether you would be able to file and give me this report so that I will be able to produce it to you. I will give an MRL. The other person has already reported. I will get the form number 26A, part A, part B from the concerned associate and the auditor and place it before the AO. You don't make a disallowance of 40A1. Quite reasonable request one can come up with. In which case, necessarily we have to say in para 3 of 3CA, para 5 of 3CB, that information furnished in class 21B based on the request, therefore strictly the entire disallowances are not reported there, is something which we will have to mention. Now these are all relating to income tax law. Now we'll come to very small two important provisions with reference to ICAI's pronouncements. What does it say? ICAI guidance note very clearly says this. Para 11.9 of the Institute's guidance note says, when we amended or introduced SA 700, amending the tax audit, the audit report for giving our opinion, we have made certain clear emphasis on role of the auditor, role of the SSC, our scope, etc. But those things, when we release our report in form number 3CB, it is not possible to incorporate because there is no sufficient provision. Space is not there. But whenever we are releasing a report, as per SA 700, we have to highlight all these things. Then how to do it and where to see this? That's the question which our Institute's guidance note in para 11.9 categorically says. So after giving the revised audit report, forming an opinion and reporting on the financial statement, a revised statement has to be taken care of. SA 700 says so. So now one will have a doubt whether this can be made as a separate annexure. The revised report, whatever the scope, limitation, all that whatever we say, can this be made as a separate annexure? And can it be said in para 3 of 3CB? Subject to above, we'll say comments, observation, inconsistencies. Can we say refer our annexure A enclosed? Or can it be referred in para 5, which says information relating to tax audit form number 3CD? Our institute guidance note says, one may say that why not we keep it in para 3A rather than going to para 5 of 3CB. But institute guidance note comes out with an idea that para 3 talks about inconsistencies, observation, comments relating to para 3 capital small b dealing with 3 items: books not produced or books produced verified for the purpose of this, branches not visited, all that whatever, and true and fair view. And therefore, with reference to that only para 3 small a can come. Therefore, it is ideal and advisable to mention the scope, paragraphs, etc. in para 5 of 3CB. Why should it not come for 3CA? Because 3CA is audit under any other law. In any other law, on that audit report itself, we will say all these things. Therefore, these are not required to be mentioned. But what is required? Only when the audit is conducted under income tax law and we give form number 3CB, there is no adequate provision to mention all these things, for which we will have to give a reference to annexure in that, and that annexure should be added along with that other documents to be annexed and part and parcel we are sending across. There we have to say. Para 11.10 of the guidance note says we have to say assessee's responsibility and also the statement of particulars in form number 3CD. We mentioned at the beginning, it is the responsibility of the assessee to furnish information in 3CD. It is our responsibility only to verify the correctness of that information. That statement, assessee's responsibility is to furnish information in 3CD. Our responsibility is only to verify the correctness of the information furnished therein. That has to come. So now, audit required under any other law. In that audit report, all other scope of assessee and ourselves will be mentioned. Audit under the income tax law, we will have to reproduce it. Even in a case where audit is required under any other law, auditee's responsibility for furnishing information in 3CD and our responsibility in verifying such information has to be mentioned in para 5 of 3CA. So para 3 of 3CA. In para 5 of 3CB, both, not only relating to form 3CD, also SA 700 requirement have to be given. So in many of the cases, this SA 700 requirement in 3CB and both 3CA, 3CB relating to 3CD disclosure, assessee's responsibility and our responsibility, that was not found. The guidance note clearly provides for furnishing this, which were not adhered to in some of the cases. Therefore, attention is drawn to the member to take into account this important information. The responsibility of the assessee and auditor, that paragraph missing. In some of the cases, it is mentioned that these are given separately as an attachment and furnished to the assessee manually. What is required is to incorporate this and furnish in the portal. Giving it manually is not appropriate. You can independently give it manually, but still it has to be given in the portal also for the review of the authorities, etc. Second one is that para 3 of 3CB. We report following observation, comments, discrepancies, inconsistencies. If we see the second one, subject to the above, I have obtained information explanation which to the best of my knowledge and belief necessary. Proper books of accounts have been kept. In my opinion, and to the best of my information and explanation, the accounts read with notes give a true and fair view. With reference to these three, if there are any inconsistencies, comments, observations of a qualificatory nature, that should be mentioned here. Anything other than that, not in relation to these three, and that too in the nature of a qualification. Observation, comments, discrepancies, inconsistencies. That means if these are positive, there is nothing to say, nil. If any one of these has got certain negative aspects, then we will have to say this. Something other than these three, and within these three, something not in the nature of negative should not be reported here, is what our institute guidance note says. Para 15.5 of the guidance note categorically highlights this. Any other observation, discrepancies which do not have the matter specified on that should be only forming part of notes on accounts, should not be in the para 3 class A of 3CB. So this is what our institute pronouncements highlighted which need to be taken care of. In conclusion, one should appreciate that good number of cases our members burn midnight oil, spend considerable amount of time, even in a case where at the last leg the case is coming up for audit, our people take up a lot of time and put themselves as well as their teams to ensure that audit is conducted and the assessee doesn't face with any penal consequences. Ours is the profession where we take onerous responsibility and ensure that the assessee doesn't run into trouble, because our forefathers have trained us and we have been following the same legacy to say it is our responsibility to ensure that the assessee doesn't end up in trouble. We take more of their trouble and as if it's our trouble. And in some of the COVID scenarios, because of various pressure, and sometimes not even one season of the tax audit would witness a case where there is no problem to a chartered accountant. Every tax audit season, some or other plots of the country or region, we will have some problem to some chartered accountant. Sometimes young age casualties take place and really the family is in trouble. All that we have witnessed for the reason that our members taken this particular exercise for a heart and soul requirement, and they do enough amount of efforts they put in and they do justifiable job. Whatever noticed is only aberrations, one in thousands of cases. But in a very nicely presented a white sheet or a white cloth, there is only one blue dot or a ink fallen on that particular white cloth, the entire white cloth will not be seen, but only that blue dot ink alone would be seen. Therefore, even if the small quantum, whatever errors found, in order to bring a good reputation among the business and other communities and stakeholders, some amount of uniformity, consistency is warranted, and that's the reason why our institute has taken the step of presenting this work from the TAQRB. And the May month journal highlights very nicely in page number 36 to 41 of the May month ICAI journal. What's the role of the QRB? If the non-compliance is non-material, it's only immaterial non-compliance, an advisory will be given to the member to ensure that it is not repeated again. But on the contrary, if the non-compliances of serious nature or material non-compliances, then it may be referred to Director Discipline of the ICAI for initiating appropriate action against the tax auditor. And we will only sincerely wish that these things should not happen. All of us put in our efforts by heart and soul and ensure that these even smallest number of aberrations found out or whatever comments came up, we ensure that it doesn't happen in any of the audits we sign, and we come up in such a fashion that the whatever name so far our forefathers have given to this profession, we continue to hold. The perception of the industry gradually puts the SSE, or the perception of the industry gradually puts the position of the auditor slightly less than what it was previously. And I'm of course finding it very sorry to say this, our year professionals, seniors, veterans, when they go to a particular function, they would be given red carpet welcome. But today in the recent days, we could see some of the cases where the SSE started thinking that I'm paying and you are rendering service. What else otherwise? The bondage, etc., is gradually declining. So, though it is very difficult to digest, but we need to appreciate that from 194J, gradually it goes to 194C. The nature of service, the SSE started feeling, I'm paying you, you are rendering service. What is there other than that? So the professional, from where gradually the SSE started feeling as if it is 194C. Therefore, we should not go beyond a particular Lakshman Rekha to help. We will have to draw our line very clearly and see that what our institute has said, we'll have to take the precautions and report appropriately, come what may, so that later on, when something goes wrong, these institute pronouncements would definitely help us to safeguard ourselves. there is no need to have a separate professional indemnity insurance policy if a person has followed the institute pronouncement sincerely, documented things, kept on record everything. Then even if something goes wrong, these things would help him to defend the case better. And therefore, let us all work towards it, take it in that spirit. And whatever so far discussed, I find it extremely difficult to take up this particular topic, because why should I discuss something which are only on a negative note? I find it very difficult to discuss only on a negative note, which is not appropriate for a profession like this. And therefore, let us see that even the small negative notes are also not coming up, and let us all live to the expectation of the stakeholders and see that our institute's flag is flying in a better height. Thank you one and all for your patient listening. Thanks to the organizers for giving me this opportunity to discuss this topic, and over to organizers.
Yes, sir. If we will, Silva, will you please check whether questions are there?
We do have some 20
We'll
questions.
take some questions, sir.
Yes,
Yeah.
sir. I'll share my screen.
What you are giving me screen?
Yeah,
Okay,
and just give you the.
one second. I'll just finish.
Yes, sir. We'll have a break soon.
In class 26B, whether an expense is incurred and paid before 31st March required to be reported. One second. 26B, let me just see 26B. We'll come to that question a little later. Other questions we'll start seeing. Whether Form 3C is required to be filed in case of company where it is less than 1 crore. Good. For a case where the business turnover is less than 1 crore, audit is required to be conducted under any other law, but not under income tax law. So now we'll come to class A of section 44A, where in case of an SSC, the turnover, gross asset, sales in business exceed 1 crore, audit is required and report has to be given. In that absence of it, tax audit is not required. What is required is only corporate audit and regular return filing. Due date will be similar to that of tax audit, because due date for a company is similar to tax audit case, but audit report under 44AB is not warranted. In financial year 18-19, turnover 40 lakhs, opted 44. I expected this question because interviewing between 44AD subsection 1 and 44AB class E, very interesting proposition post 2017, because the law underwent a change in 2017. Prior to that, it was different. Therefore, this particular understanding is clearly warranted. Let us come back. 1920, turnover exceeded 1 crore, audit done under 44AB. Turnover exceeded 1 crore. Okay. 2021, turnover 35 lakhs, whether audit is mandatory, the SC files written with books of account without audit, what are the consequences? Now let us say 19 March, the turnover opted 40 lakhs. Before going into the query, first quickly let us see 44AD, prior to 2017, post 2017. Prior to 2017, the old law of what was there in 44AD, what was there in 44AE, what was there in 44AF previously. Offer this much. If you do not offer, get the accounts audited, maintain the books. But quite strangely, in 2017, 44AD, subsection 4 and 5 underwent a change. Subsection 4 and subsection 5 went on to say, if you have opted under subsection 1 first, that means you have taken a presumptive provision. And thereafter, in any of the subsequent 5 years, having opted subsection 1, any of the subsequent 5 years, if you do not opt, then next 5 years you cannot come into this provision. And in that period, you have to maintain the books of account and get the books audited. So to do this, fundamentally what we have to see, whether you have opted under subsection 1. Why I am repeating this again and again? Previously, the first year, the partnership firm starts its business, first year, 45 lakh turnover, 8% income is not there. Being first year, they are stabilizing themselves. Less than 8%, less than 6%. Audit necessary, not necessary. Because that is not a case where previously under 44 AD you have gone. It's the very first year. Actual book results you can declare. So fundamentally, for the purpose of audit under 44 AD subsection 4.5 read with section 44 AB clause E, first what we have to see, previously whether you have opted subsection 1 of section 44 AD. Have you opted for 44 AD? If you have previously opted, then 5 subsequent years you should have the eligibility to come in, but you have not opted. In that case, year of opting out and subsequent 5 years you cannot opt in. That 6 years time you have to get the accounts audited. So previously, if you have not audited, previously you have not opted, you can continue to be outside 44 AD. Let us say, for example, 2019-21 firm started 60 lakh turnover, 2 lakh rupees income. It need not come under 44 AD. So next year, 75 lakh turnover, 3.5 lakh rupees is the income. Previously, it was not under 44 AD. Therefore, second year also it need not. So if the assessee up to reaching 1 crore rupees need not come under 44 AD at all. Once it crosses 1 crore, 44 AB class A will come. 1 to 10 crore, just further examine whether it has followed that 5% cash transaction criteria. If it is less than 5%, up to 10 crore also it can continue to go without audit. 44 AD is not required to be followed. But if a person has followed 44 AD, knowingly or unknowingly, he has come under 44 AD in the preceding year. Here he has followed. Count subsequent 5 years. In any one of the 5 years he walks out. That year plus 5 years he cannot get in. In that year he has to get the accounts audited. Keeping that in principle, now we will see the query. Financial year 18-19, turnover 40 lakh, opted. That's the first year. And 40 lakh is the turnover. Profit is less than 5%. If they have now opted also, nothing wrong in it. Law does not say you have to necessarily opt it. Because your turnover is less than 40 lakh, less than 1 crore or 2 crore, and you have got less than 8%, mandatorily you are not required. What is required to be seen? Whether previous year you have got 44 AD. Previous years you have got 44 AD. From 17 April 1st onwards. That's the question we have to address. Now, knowingly or unknowingly, this has been opted. Now, subsequent year, they are not into 44 AD. What the loss is? You opted in year 1. Next 5 years, you should continue. If you do not continue, year of getting out and subsequent 5 years, you cannot get in. Means in the year of walking out, you are otherwise supposed to be entitled to, but you are not willing to be. Only then it can be said you are walking out. The section is not applicable to you in the second year. You are not willing to walk out. The section itself is not applicable to you. That should not be construed as you are walking out. And therefore, that year and subsequent years, you have to necessarily get the accounts audited. You cannot walk in. That rule should not be applicable. Keeping that principle, now we'll see. Second year, turnover exceeded 1 crore and they have done audit. Now, up to 2 crore, they can continue to be in 44 AD. Now, for some reason, let us presume for a moment, they have walked out. If turnover, because if it is turnover exceeding 2 crore, then it is okay. They have not walked out. Section is not applicable to them. Now here, up to 2 crore, they are entitled to be inside, but they have walked out by opting under 44 AD. In which case, subsequent 5 years, they are required to be outside 44 AD and they have to get the accounts audited so long as income exceeded the basic limit. Now, let us say in the same example, financial year 19-20, the turnover is 2.5 crore. They have not walked out voluntarily. The law hoisted them out. In that case, subsequent year, for the purpose of counting 5 years, subsequent year and the remaining 4 years, they can walk in, offer under 44 AD. So when it will be regarded that you are violating, you are otherwise entitled to be in, but you are voluntarily getting out. In that case, year of walking out and 5 more years, you cannot get in, and that 6 years you have to get the accounts audited, provided in that year, that 6 years time, income must exceed basic limit. Only then the provision would be applicable. So in this case, we'll have to see whether 1 crore or 2.5 crore, depending on that, this issue would be taken. Now, if the assessee files return without doing audit, what would happen? If there is no audit, only 271B would come. for not getting the accounts audited, consequential penalty will come. But one will not be able to enhance the income to the extent of 8 or 6%. Book results will be accepted subject to other defects or other establishing the genuineness of the transaction. Any professional person other than 44AA prescribed, whether 44ADA would be applicable or not. Interesting question. 44ADA says that section is applicable only to a person coming under 44AA subsection 1. That means for a person who is coming either a specified profession or a notified professional, put together 11 people. Only for that 11 people, 44ADA is applicable. For others, 44ADA is not applicable. That means all other professional cases, 44ADA will not come. Therefore, for them, 44AD also will not come, because 44AD would apply only for business, not for profession. Therefore, those people will go with their normal books. If the books are required to be maintained, they will maintain books of account, go with result. 50% commitment is not there. 20%, 10%, 5%, whatever comes as per books, they can furnish the return. Clause 80 applied only when a person opted out of presumptive income, even if it applies irrespective of turnover. If it applies only to person opting out of presumptive, means what clause would apply if my turnover is below 1 crore and profit is less than 8%? Please give clarification. In which case clause 80 would come if you voluntarily opt out. See, previously you have opted in the subsequent 5 years time, any 1 year you opt out voluntarily in that year, and the subsequent 5 year, clause 80, that 44 clause 8, in clause 8, 44AB clause E is required to be chosen, provided in that year income exceeded the basic limit. In that case, we have to choose clause E. In case of donation given by a company disclosed under personal expense, does it mean that ATG deduction not available? Does it mean we should disclose the donation under personal expense? First, donation would not come under personal expense. For a company, Sayaji Iron and Engineering Limited, Rajasthan High Court went to the extent of saying, for a company, there can never be personal expense. It can be personal expense of the employees. Company is an incorporated body. Therefore, for a company, there can never be personal expense. Let us say, for example, managing director uses the car partly for business, partly for personal. To the extent of personal expense, it is nothing but salary in kind. Tax him for the perquisite. For a company, it's a business expense only. You say in the agreement he is entitled to use it partly for business, partly for personal. You are giving him much salary in kind. Tax him for perquisite. If you give salary in cash, you are allowing. Similarly, for salary in kind, you allow. That is what Sayaji Iron and Engineering Company, Honorable Rajasthan High Court has mentioned, and therefore, for a company, there is no personal expense. First, donation given is not an expenditure allowable under 37. But so long as ATG is available, it is possible to claim it. So those cases are not required to be reported in clause 21. Now, very interestingly, section 37, subsection 1 says any expenditure not being personal in nature, not being capital in nature, not covered under 30 to 36, laid out wholly and exclusively for the purpose of business or profession shall be eligible. Not being personal in nature, therefore we have to say in tax audit report. Not being capital in nature, we have to say in tax audit report. Then not covered under 30 to 36. 30 to 36, whatever is required to be reported, we will report in the respective clauses. Laid out wholly exclusively for the purpose of business. There are certain transactions not laid out wholly or exclusively for the purpose of business. They are not required to be reported in tax audit report. Assessee has to voluntarily disallow it in the statement of total income. Donation is one such thing. They are not required to be reported in 3CD clauses. But eligible quantum of donation, if found in the books, quantified in chapter 6A, it has to be reported. All the disallowances made by assessee need not be reported in tax audit. What is required to be mentioned in 21 alone is required to be mentioned. Selva, you need to scroll down. Is it not the LLP treated as partnership for the purpose of Income Tax Act? Absolutely correct. For the purpose of partner, Income Tax Act section 2+31 definition of firm includes LLP, and the partner includes 223 also further goes to say partner means partner of LLP as well. No quarrel about it. But question is whether the accounts of that particular entity required to be audited under any other law. If the LLP Act 2008 says your contribution exceeding 25 lakh or your turnover exceeding 40 lakh, you are required to get the accounts audited statutorily. Therefore, 44AB, third proviso would apply. But it is a partnership. Tomorrow, if partnership law is amended to say you have to get the accounts audited after turnover crosses 5 crore rupees, it is a partnership form. But under Partnership Act, an audit is warranted. Therefore, third proviso to 44AB would apply when we are filling up class 11 of class 8 of section form number 3CD. Class 13F, whether disclosure of ID is mandatory even in cases where adjustment of profit is not required. Absolutely correct. See, mandatory adjustment may not be there. Let us say, for example, your accounts are drawn up in consonance with ICDS. There is no adjustment warranted. But ICDS says out of 10 ICDS, 8 ICDS says recognition, measurement, also disclosure. So the disclosure part, in each ICDS, one has to disclose certain things. There are 2 ICDS for which no disclosure warranted. Remaining ICDS, let us say for example, fixed assets. For fixed asset, ICDS says you have to disclose opening WDV, addition made, the aggregation amount, and the reduction on account of sale of assets, fluctuation under 43A, subsidy received, SENVAT component, and the closing balance. These are the required disclosure, which we can say refer to class 18 of the form number 3CD. There is no variation, but this is required to be reported. Every ICDS has got a disclosure component. Even if the accounts are drawn up in accordance with ICDS, whereby there is no adjustment at all, but the disclosure cannot be dispensed with. We will have to make a disclosure in form number 3CD class 13F. This I think we will again come back. 26B, I have to just check the class and come back. Class 18, disallowance under 38(2) for personal use. Gross or net depreciation to be reported, no such column in 3CD. Very interesting proposition. Class 38, section 38, clause 2 says, if an asset is used for non-business purposes, assessee can estimate that portion of the depreciation which is not required to be claimed and disallow it. Interestingly, assessee may prepare the computation of total income, computation, etc. and for 32 he will disallow. In class 18 of 3CD, there is no provision to carve out the disallowable component of the depreciation. Let us say, for example, there is a proprietor having a car. Assessee says voluntarily 40% of my depreciation I am not interested, sir. I don't want litigation. 40% I will take away. Balance only I will claim. In the computation of total income, when he is furnishing the assets and the eligible depreciation, there is a provision in the schema under 38(2) how much to be disallowed. You can remove it. But when the tax auditor approves this, or when the tax auditor approves class 18 of the 3CD, there is no clause to say how much disallowable under 38(2). So necessarily auditor has to say the gross amount as eligible depreciation. But para 5 of 3CB, auditor has to say, since there is no clause or a column in class 18, the amount of depreciation attributable for the assets used for personal purpose not quantified. However, the same is disallowed in computing the total income by the assessee if the assessee gives draft computation statement. If it does it subsequently, nothing wrong in it. But at para 3 of 3CA or para 5 of 3CB, we will have to make a mention of it. But alternatively, one may say, why not I myself reduce and put it, but the class doesn't. If you see, it will appear as if there is an error. The percentage, if you apply for more than 180, less than 180, and still reduce 30% or 40% for personal purpose, it will appear as if there is an error which is not appropriate. Then, in case of an individual who is a partner in firm receiving remuneration from exceeding 25 lakhs and does not have any other income from business or profession, business code is used as income from partnership. In such a case, whether such individual is required to maintain books of account. He is receiving remuneration from, okay, if the books of account not maintained, details of P&L balance sheet not filled, will the ITR be treated as defective? See, effectively, personally speaking, remuneration interest received from a firm is not to be regarded as a business source by itself, because although section 28 clause 5 says it is taxable under business, it is the firm which carries on business. He is only a partner. He is not carrying on a business. Therefore, obviously, it should not be considered as he carrying on business. Therefore, a books of account is required. But unfortunately, the schema is drafted in such a fashion that moment he has income exceeding 25 lakh or a turnover exceeding 25 lakh, after claiming that turnover includes that remuneration and interest received from, after which he starts claiming deduction towards interest paid to third party, any other managerial administrative expenses. The schema says your gross receipt turnover in business exceed, you have chosen business, it exceeded 25 lakhs, and therefore necessarily you have to get the books maintained, in the absence of which return will be treated as defective. Definitely this technical issue cropped up in the last year of February, March, etc. In order to avoid, better to furnish the information, although one can have a very strong case to litigate, having the return got defected and made as defective return, litigating, etc. may not be an ideal choice. Better to rectify the defect by providing information. Class 11C, documents examined. If the purchase invoices are not verified by auditors since the SA has not kept arranged the bills properly, how auditor will report? In 11C, examined, documents examined, there we will not fill up the purchase invoice at all. What is not produced for audit, we can say, the assessee may say in class 11B, books and documents maintained. In maintained, he will say purchase registers, purchase invoice. In the books and documents examined, we can say purchase register not verified, purchase register is there, purchase invoices not verified, therefore we will take away that. That's all. What is not verified, we can remove it from the list. To that extent, when somebody compares books examined, books maintained, the gap would say books not produced for audit, evidences not produced for audit. If by error a foreign rent or expense due to non-payment of TDS disallowed at 30% instead of 100%, the assessment is over, what is the remedy in the current year? Leave it as it is until 154 is picked up voluntarily by assessee or by the department. Leave it. The remedy cannot be in the subsequent year. The current concerned year only it has to be addressed. In the subsequent year, voluntarily adding another 70% is not a solution. Last year I disallowed 30%, this year I'll disallow 70%, therefore don't disallow last year 100%. That is not the remedy. One would not be able to take that as a chance. If the purchases appearing in 26 AS and TCS reported by seller is not matching with the purchases in the books of account, whether the reasons are to be analyzed and reported in 3CB. Tax audit report where to mention the mismatch. Fine. See, it is the duty of the assessee to verify and mention what it is. If there is a doubt on the quantum itself and the assessee is unable, if the assessee's other documents are very perfect and there are few transactions which assessee claims it is not his transaction, it is somebody else's transaction, and the assessee is able to demonstrate it by providing adequate confirmation, etc. There is only error in 26 AS which the other party says he will correct, etc. Then it can be ignored. The assessee is not able to come up with enough documentary evidence to support his version. Now there are 2-3 other consequences. One is the numbers are such that we are able to satisfy about the genuineness of the other transaction, truthness and fairness of the accounts and results. Then para 5 of 3CB, para 3 of 3CA would be sufficient. But if it goes to the very deep rate of the maintenance of the accounts, etc., the numbers are so varying, then the qualification disclaimer in the audit itself is warranted. Depending on the nature, quantum, we have to take a call suitably. 34C, tax is not deducted, whether interest is to be calculated and reported. If yes, up to what date? From the date of incurring expenditure to 31st March or date of filing the report. If the tax is not deducted, now there are a couple of outcomes we will have to examine. The tax is not deducted, but the assessee claims other person has already reported, he'll get form number 26A. In which case form number in 201 capital A says from the date on which it is deductible to the date on which the other person has filed a return, interest has to be calculated. If the assessee says I will not obtain that, in which case up to the date of the audit report it has to be quantified. Anyway, if the other person has already included, 201 1A cannot be avoided. Only disallowance under 40A 1A can be avoided, but 201 1A interest will come from the date on which it is deductible to the date on which the other person has filed a return. Till such time it has to be quantified if form 26A obtained. In the absence of which, till the date of audit report, it has to be quantified. And beyond that also it will continue in case proceeding under 200A or 201 unstarted. Due to advances received, turnover as per GST is higher than the turnover as per books. If fill up turnover as per GST in IT return, assessee may receive notice. What to do? Should we mention this difference in 3CD or report anyway? See, because of GST, if the turnover in the GST's perspective, the advance is taken as turnover. From accounting part and income tax part, that is not a turnover. So long as we have a proper reconciliation to say opening advances previous year not considered as turnover, current year considered turnover. Closing advances current year not considered turnover, next year it will be considered. But on aggregation of and exclusion of the respective numbers, GST return and this return matches, then there is nothing to report. We can always cross verify and say. So therefore, what is required is only the turnover as per the method of accounting followed. GST return related turnover to the extent of advances need not be factored. And it is not even required to be stated there is a variation in turnover, because we have satisfied ourselves this is the turnover. And we also know that this portion of the turnover included in GST is not on account of rendering of services or parting with goods, it's only an advance, in which case it is not required to be reported anywhere. What if the address as per PAN is not matching with MCA portal? What address to be filled? Now we will have to see which is real. Supposing MCA portal is correct, but PAN is required to be updated. They amended they altered the registered office and they have already moved. MCA is altered, but PAN is not corrected. Ideal to give MCA latest address on the date of signing the audit report and ask the assessee to address the issue by filing revised form number 49A. GST ITC on capital expenditure relating to 1920 found ineligible in 20 while form 9C is filed. Can we take this ITC portion for depreciation in a subsequent year? If so, an interesting question. We have one tribunal judgment that in the case of old Senvet law, if assessee claims Senvet on an asset on the belief that it is eligible, therefore he has not claimed depreciation. 100 rupees is the cost of the asset, 18 rupees was the Senvet, 18 was not added, 100 was depreciated for the first year. Second year, because of some audit, that 18 was considered to be ineligible for revenue. So now for that 18, neither he claims depreciation nor he claims ITC. What to do? Next year in the addition column he has shown. And the matter went to tribunal and tribunal said in the GST this day, those days service tax or excise duty, Senvat, that was not eligible. He did not claim. Then what prevents the assessing to get the benefit in the income tax? In the year in which it is found ineligible, from that year onwards, prospectively, depreciation can be claimed. So it has to be shown as an addition in the year in which it is found ineligible, that year as an addition. Since the asset was put to use last year, in the first half itself, it can be shown as an addition and depreciation can be prospectively claimed from the second year. Do we need to report interest on TDS as per financial statement or interest paid against previous year TDS liability? As per the books, in the year in which whatever we identify for that year, whatever interest paid in that year and subsequent year. If the interest is paid in the current year in relation to previous year, suppose previous financial year some interest is due, that interest is paid in the current year, that is not required to be factored because that should have been reported in the preceding fiscal audit report. Whatever is for the current year, either paid in the current year or paid in the subsequent year, that requires to be reported in that class 34C. In case of real estate companies, for the sales made, do they need to mention customer-wise detail for the purpose of section 216 SS? Interestingly, class 31, now what happens? Section 269 SS, 20,000 rupees or above. It has loan, it has deposit, then it has specified sum. The specified sum says in relation to immovable property, whether by way of an advance or otherwise. Or otherwise is interpreted to say it is not only the money received at the time of or as an advance, even at the time of registration also will come. So in that case, what will happen? Sale consideration received for sale of immovable property by way of land or building will be attracted under 269 SS if it is by way of account pay 20,000 or above. So if you receive a account pay across check or draft or ECS, you are complying with 216 SS. If you do not receive, you are caught with 216 SS because of this. Now it's a real estate company. It is selling plots, getting through account pay cross check. Even then, 216 SS would get kicked in. Our institute guidance note says The objective of requiring the information to be produced in clause number 31 is to enable the assessing officer to examine whether a penalty is required to be levied. In principle, as an auditor, we are required to say all the transaction of 20,000 above for 216 SS and T, of 2 lakh above for 216 ST, even if the assessee has complied with the law. But when the numbers are so huge, let us say, for example, an NBFC accepted deposit through account pay check, thousands of numbers are there in a year. Does it serve purpose? We give the details of the NBFC's deposits when they have actually received through account pay instrument. There are institutes, yes, we can make a mention in form number 3CA, para 3. Though the entire information is required to be seen, going by purpose, wherever violations are there, the information relating to violation alone is mentioned in clause number 31. So such a mention can be made in form number 3CA, para 3 or form number 3CB, para 5. If the numbers are many and we have ensured that we are either by chest check or otherwise we have ensured that violations are not there, to the extent of violation alone, if you report and make a mention in the main report, it will be sufficient. Sale of scrap is to be added from revenue from operation in clause 40. In that case, there will be a mismatch between 3CD and FS. Is it fine? It is appropriate. You can have a sale of scrap in financial statement as other income, miscellaneous income. For the purpose of turnover under 44AB, you can aggregate and present it. Nothing wrong in it. Loan received in earlier year from a party adjusted against the current year purchases by the said party should be disclosed in 216 ST. Silva. Okay. See, it is loan received and repaid, otherwise than by way of account pay, crossed check or draft. Technically speaking, it is required to be reported. But by going by purpose, this is not in violation. Delhi High Court said when you pass a journal entry to close a loan, that is not amounting to violation going by the purpose. Therefore, it is not required to lead to levy of penalty. By way of abundant caution, it can be reported and said it is through journal entry. Therefore, it is not violation. By way of abundant caution, one can say. But as I said already, giving information is the prerogative of the assessee. Our job is only to verify the correctness of the same. If the assessee chooses not to furnish this in clause 31B, our job is to say there is one loan closed by journal entry. Assessee chooses not to furnish that information on the premise that it is not amounting to violation of 216 SC, relying on the judgment of the Honorable Delhi High Court. Therefore, such information is not furnished in the relevant clause. We can mention in para 5 of 3CB or 3 of 3CA as the case may be. While filing form 3CD with regard to disallowance of partner remuneration, there has been some typographical error. Hence, there arises demand. It is purely typographical error, whether we can revise the tax audit report. Very, very technically, one should not go to the extent of revising the tax audit report, but there are enough amount of evidence to suggest there is only a typographical error, last minute rush, etc. One can defend it. All other precautions care is taken while conducting the audit is only a typographical. One number got interchanged while punching the information. People who are punching the information in the portal are also human beings. When all other care is taken to conduct the audit properly, merely because the number got punched interchangeably, and for that reason we cannot put the assessee in trouble by retaining that audit report, we can write a note and revise the report. Therefore, under 143(1), when it gets reprocessed, the demand will vanish. Nothing wrong in it. Any professional person other than 11 professional, whether 44 AD is applicable? I think we have answered this question. My client, who is a doctor, earns professional income in excess of 50 lakhs, because of which he is liable to tax audit. He also earns rental income. Whether disclosing his financial, should I mention professional income? It is the choice of the SSA. Books are maintained for professional income. He can keep his all other income, capital gain, rental income, other sources income outside books, for which he can maintain a separate books also, prepare a personal balance sheet. That's a different. So long as he maintains business books or professional books, produces that to the auditor for audit, and that is conducted, we have to mention only about the professional. If he has got all other things also in the same book, we'll conduct audit, but we'll report only about professional matters. Anything of a personal nature, personal nature will not mention in the form number 3CD. Previously, if admitting profit less than 8%, presumptive under 44 AD for turnover below 1 crore, books have to be audited. Whether now the provision is applicable. If turnover 25 lakh, profit admitted 2%. Sir, the question is First, you have to ask whether previous year you have come under 44AD subsection 1. If you have not come, you have not got the account, your previous, this is the first year. Previously, you were not under 44AD at all, post 2017. This is the first year. Turnover 25 lakh. Turnover profit is only 2%. No need for getting the accounts audit. That the law previously up to assessment year 17-18 was less than 8% necessarily get the accounts audit. Post 17, previously you should have availed 44AD subsection 1 and first 5 years thereafter. Any 1 year you walk out voluntarily, that year and remaining 5 years, 6 years, you cannot walk in that time. 6 years you have to get the accounts audit. If 6 years are over, first year you have opted, next 5 years you opted, 5 consecutive years you opted. Thereafter, 7th year, 17 March, 18 March law came, 18, 19, 20, 21, 22, 23, all the 6 years you were in 44AD. 24 onwards, that restriction of 5 years is not. Any year you can walk in, any year you can walk out. Nothing wrong in it. Permissible. That is what the law is all about. Only question is 26B. I'll just check the text of it. That one question we have to answer. Okay, it is 43B related questions. For 43B, if the amount is already paid, the payment is already over before the end of the financial year, there is no need to report it. One understanding is what is paid in the financial year is also required to be reported. That is not correct. Outstanding as at the end of the financial year, reported, paid before the due date of furnishing return of income is required to be reported. So if it is paid before it is outstanding on the last day of the financial year. By technically reading that clause, that language in the form, somebody took a view that anything paid in the financial year is also required to be reported, which is not appropriate. The purpose is before the end of the financial year, if it is paid, there is no disallowance. Afterwards, if it is paid before the due date of furnishing return, it will qualify. After that, it will not qualify. Therefore, anything paid before the end of the financial year not required to be mentioned in form number 26 clause B. Any other questions?
Mostly answered, sir.
Thank you all for your patient listening. My pleasure to give thanks to all of you and share some of my thoughts. As I said at the beginning, the topic is slightly discomfortable, but still, in order to enhance the image of our profession amongst the stakeholders, with some heavy heart, I started penning down. When I started typing it and I started dictating, I found it extremely difficult to say this is not there, that is not there. Very, very difficult to say this when we are very elite professionals, and 99% of the cases we are doing all these things, and only one small percentage things are not going good. We used to paint that as a very big picture to everybody in the world. So therefore, it was very difficult for me. But still, in order to ensure that in the long run, image of the profession goes up very well, this needs to be done. Internally debating ourselves and setting things in order, nothing wrong in it. Only externally we should not do. Therefore, in that spirit, I started working on it, and a day should come where we should have some other topics for discussion and not a topic of this nature. We'll wish and pray for it. Thank you one and all for your patient listening. Thanks a lot for the opportunity, and the Chalapati has made me to discuss this topic. Thank you, and the office bearers over here. Thank you all for your patient listening. Thanks for the opportunity. Over to Organised.
Thank you very much, sir. Any comments from chairman?
I think I can proceed.
Yes. Thank you very much, sir. As usual, despite your discomfort about the topic itself definitely have done more than justice, because it is very, very important for the members to know what are the commonly found errors, because the purpose of the board itself, TAQRB itself, is that one. Even MPV sir has mentioned more than one time, the number of times, that this we have to gear up and see that we follow all these things, especially standards and auditing and accounting standards. That the lapses are becoming more visible, which is not good in the interest of the profession. So this being the core area for the practitioners, a tax audit report definitely, as you said, it may be 1 in 100, 1 in 1,000 like that. But the same position is not there in SAS and accounting standards as per the view of MPV sir. So we cannot be complacent at all. So that is the reason why our chairman has taken up this topic for discussion. And the members definitely, as rightly pointed out by sir, we should observe that we are discussing all these things within our within the framework of the members area. We are not going to the outsiders, so we should not be hesitant to correct ourselves and update ourselves on these matters, which will definitely go a long way, considering the government's what's called faith in CAs, that should be kept intact and also should be enhanced consistently. So with these words, I thank very much Ramswamy sir, Ramnath sir, for your presentation. And as usual, you are very clear and down to earth. You have clarified all the queries, and definitely you are always most sought after speaker on these matters. I have seen most part of Karnataka also, all of them love your speeches, especially Mysore, Mangalore, Udupi and all. They are very Belgaum. All these branches, they call you very frequently. The other part also, they are very keen. So it is very, very important to note that you reach the small and medium practitioners in a very simple language, simple presentation. That is most important, because almost 70 to 80% of the practitioners are SMPs. They are to be updated and just alerted to concentrate on these small matters. You have done a great job in this. So, thank you very much on behalf of SIRC, sir. And your humbleness is one thing that is always laudable. We have to learn from you that the attitudinal side also, we have to learn a lot from your side. Thank you very much for that. I thank you all the members for the great support that you have given for this program. Name itself makes all the difference. So when sir is speaking, definitely you are all interested, and the topic is additional interest. And also the non-compliance and the common errors must have also made you to enter into this. Very good numbers. In the morning itself, it was 675. I don't know what is the number by end. It would have reached nearly 1,000. So great support from the members. I think you are all benefited. It is a very worthy day to learn from the erudite speaker. So thank you all for your support. I thank the chairman also for the topic, and the back office of SIRC for the support, and Selva for setting the things right in between. We were worried when there was technical snag. He has always been there as backbone of these technical programs. Thank you, Selva, for that. Thank you all, and good night.
Thank you, sir. Thank you. Thank you.
Good night. Thank you.